all my dear students, I hope you all are doing good. So today the day has come for which you all have been waiting since long. That is the day on which we are going to start with our comprehensive revision videos relevant for your May 23 and November 23 exams of CA Final Direct Tax. So let me give you a brief idea about how we are going to go about and what will be the coverage of this revision videos, so on and so forth, before we can start revising with the first topic. So we are going to revise the entire subject, don't worry about it, and by the end of March I will try to upload all the revision videos of approximately 15 to 20 hours which will comprehensively cover the entire subject with minute detailing, with great interlinking of provisions of one provision with another provisions. And this time I am going to improvise on what I have done in the last time. As we all know that we all should improvise in life, so am I. So I am going to improvise this time, and this time I am going to not only provide you the revision videos from the textbook, from our colored book, but along with that we will also be doing the revision of the practical questions. The practical questions, how can we revise the practical questions? Yes, we can. Why not? As a student, you don't have time on the day before examinations to revise a practical question. So we will be revising the important adjustments of the important questions, so that if you don't get time to solve questions on the day of examination, you guys can at least watch this video and get well versed with the questions. So this time we are going to improvise with this. Along with that, very soon we are also going to discuss all the MCQs of the ICAI MCQ booklet which the ICAI has given to you all. So I request you all to go through all the MCQs, try to get the answer, and then I'll be coming up with a video explaining the reason for each and every MCQs the way I have done it for Hindi students. Okay, I've already done that for Hindi students, so I'll be doing this here even for my English students of South India especially. Okay, because you guys have some problem in understanding the Hindi. No issues. I'm always there for you all. So this time we are going to do some great revision. Believe me, if you follow this revision consistently and if you watch them consistently, repeatedly, I don't think so you even have to open your books then. Need not have to open your books, because I'll be showing you the books on the board and the books will be there right in front of you. You need not have to open your books. Yes, if you find some point important that you forget, then you can stop the video lecture at that time and then you can mark it down in your books. That might be the only use of your books now after watching this revision videos. Okay, so don't pressurize me. One thing, sir, when you will upload the next video, I will definitely upload. I've given you the deadline. By the end of March everything will be uploaded. So the last 1 month you can revise. In between also you can revise. I'm not saying that I'll be uploading the entire lecture in the last month. No. I'll be uploading almost in every 3-4 days one video will come for you all. Okay, so now let's start without wasting any further time. Let's start with the first topic of revision, and that is going to be our PGBP. Let's start the charging section of PGBP. We are going to address first today. So what is the charging section of PGBP? In PGBP there are two types of charging section. One is section 28(1) and there are some other charging sections as well which are called as special charging sections. So there are two types of charging section under PGBP. One is general charge, one is special charge. So right now I am interested in the general charge. I'll be talking about the special charge after some time. Sir, what does the general charge has to say? General charge has to say that profits and gains from business or profession carried on by the assessee at any time during the previous year is charged under PGBP. Now you need to understand the terminology, the meaning of each and every term. Sir, what do you mean by the term business? The business is defined under section 2 clause 13 in an inclusive manner. Sir, what is the definition of business? Business includes trade, commerce, manufacture or adventure, any kind of adventure. Where there is an adventure, it is a business. Adventure means what? There has to be some kind of risk. If you do a trade, there has to be an adventure. If you do a commerce, there has to be an adventure. If you do a manufacture, there has to be an adventure. So what do you mean by the term commerce? Commerce means when you do trade at a very large scale, at a national level or an international level, that can be called as a commerce. This is a very, very vague definition, incomplete definition. Therefore, the Supreme Court of India in the case of Barendra Prasad Ray has come forward to give a better definition of business, and the Supreme Court held in this case that business implies a systematic and organized activity by applying labor and skill with a dominant intention of earning profits. So this is a slightly better definition as compared to what the income tax law gives under section 2 clause 13. So this definition of Supreme Court gives a very important element of business, that is there has to be some profit element in your business. Okay, then comes what do you mean by the term profession? The term profession is defined with a single word under section 2 clause 36, again in an inclusive manner. The term profession includes vocation. So what do you mean by the term vocation then? Vocation means any kind of skill where you apply your skill and then you earn money. That is called as vocation. Okay. Any kind of skill, whether you have a degree, whether you possess a certificate or degree, or whether you do not possess a certificate of degree, it doesn't matter. There has to be a skill imbibed in you. Then it can be called as a profession. Now, what is business, what is not a business is a matter of great discussion, and it all depends upon the facts and circumstance of every case. Therefore, we have put some cases over here whereby we will try to identify whether it comes in business or whether it comes in some other head. Like first case, there is a huge land with the assessee, and therefore the assessee was not able to sell the land because the land is huge. Nobody is ready to buy such a huge land. Nobody has so much money. Therefore, the assessee started dividing the land into plots, and then the assessee started selling the land in plots. So, where the income will go? So, the assessee said that the income should go under the head what? Capital gains, and even the Supreme Court said that yes, it is a capital gains. It is not a business. There is no systematic or organized activity done by assessee to earn profits. The only intention of the assessee is to exit the market, to sell the market and exit it. That's it. Now, as against this, there was an assessee who bought a huge land, and on that land, the assessee is constructing a colony where he is making school, colleges, shopping mall, theaters, etc., hospitals, schools, etc., all those things. And then he is selling. Where the income will go? Obviously, this is a systematic and organized activity by applying labor and skill, and this income will go under the head PGBP. Is it clear? Third one, generally, if I ask you where will the interest income go, 99% of the students will say without thinking IFOS, income from other source. It's not correct always. Interest income can go in IFOS, it can also go in PGBP. That depends upon the facts and circumstance of every case. For example, I want a government contract. For that, I made a bank guarantee, and in that, I have made a fixed deposit so that I can give a bank guarantee to the government so that the government can give me the contract. Now, if I make a bank guarantee and because of that, I made an investment, and out of that investment, I'm getting some interest. Is that interest an investment income? No, no, no. That interest is nothing to do with investment. That interest is an incidental income because I want that project in my business. That is the reason I want that interest income. Therefore, this interest income which is related to business will be chargeable under what? Under the head PGBP as per the Delhi High Court in the case of K and Company. So, what comes in PGBP, what does not comes in PGBP? It's a matter of great discussion. Next, there was an assessee who has a factory, and in which the factory there was a lockout. There was a lockout in factory for a few months. So what assessee did? Assessee let out the plant and machinery factory, let out the plant and machinery furniture for temporary period to some other person so that he can earn at least some money out of it. Now that is his business intelligence. Technically it is known as business expediency, and therefore the income which he is learned from the let out of the property, that shall also go under what? Under the head PGBP and not under the head IFOS. Similarly, last one, if I generally ask you, where will the income of let out of godowns will go? You will say without thinking, the income from let out of godowns will definitely go to what? Will go to what? Income from house property, but that's not correct always. Here what assessee is doing? Assessee is letting out godown. Along with that, assessee is also providing a lot of services, like the services of pest control, rodent control, fumigation services, security services. All these services are also provided along with the let out of godown. So the court held that this assessee is not letting out only the godown, but it is also providing a lot of services, and therefore it will be classified under the head what? Under the head PGBP. So what comes under PGBP? What does not come under PGBP? It's a matter of facts and circumstance. You have to sit and analyze each and every facts and circumstance in great detail, and then only you can say that what comes under PGBP and what does not come under PGBP. Let's move on to the next one. Suppose I have a property and I'm letting out that property. Obviously, that property will go to income from house property. Now, suppose there is an assessee who is buying a property, and then his main objective is to let out the property. It is written in the memorandum of association of the company that our main objective is to acquire property and then let out. In that case, the Chennai, the Supreme Court, in the case of Chennai Properties and Investment Limited, and again the Supreme Court, in the case of Rayala Corporation Limited, has held that such income will be classified under the head PGBP and not under income from house property. They have given some test on. They said that if it is written in your memorandum of association that their main objective is to let out, and it is further proved that the substantial income of the assessee is from let out. This is also important to classify under PGBP. Your income should be substantially from what? Let out. In your ITR, income tax return, the maximum income should be from let out. Then your income will go under income from what? PGBP and not income from house property. So these were some of the cases which can help you to understand what comes under PGBP and what does not comes under PGBP. Okay, coming to the next part of the charging section. The next part of the charging section says that you need to earn some profits and gains. So what do you mean by the term profits and gains? The profits and gains mentioned in section 28(1), that is the general charging section, means it has to be a revenue profit. It should not be a capital profit. If you are receiving a capital profit, then it is not taxable as per the Supreme Court judgment of Saurashtra Cement Limited. Capital profits are not subject to tax. Secondly, the profits are supposed to be maybe from legal business or illegal business. It doesn't matter. Government does not differentiate between legal and illegal business. We will charge both the profits. Profits may arise in cash or even in kind, and the profits has to be real profits, real profits, real profits. If you want to charge under the general charge section 28 clause 1, if you want to charge a notional profit, deemed profit, anticipated profit, which you do under 44 AD, 44 ADA, 44 AE, like presumptive income section, then you have to make a separate section for that, overriding sections, as you can see over here. So the government can charge profits on presumptive basis, but for that the government has to make separate presumptive sections. Next, the profits and gains has to be earned by a person, it should be carried on by assessee at any time during the previous year. Sir, what do you mean by carried on by assessee? Everything has to be done by the assessee? No. Everything need not be done by assessee. What assessee has to do is, assessee has to control the business in his hands. The day-to-day activity need not be done by the assessee, but the control of the business has to be in the hands of the assessee. Like for example, a non-resident is doing business in India through its agent. The business is done by the agent, but it is controlled by the non-resident. It cannot be said that the agent is the assessee. The assessee is the non-resident only. Because just because the agent is doing the business in India, day-to-day activity, that does not mean that the agent is what? The assessee. The assessee is the non-resident only. And last but not least, it should be done at any time during the previous year. The business should be done at any time during the previous year. Therefore, it means that business need not be done continuously throughout the previous year. Even if it is done for some period during the previous year, it can be considered as what? As a business and profession carried on by the assessee. And therefore, is it necessary that the business should continue in the AY only? No. In AY, business may exist, business may not exist. What is necessary? That the business should exist in the PY. That is what is relevant. So this is what section 28 is all about. This is the general charge. Special charge I'll speak in some time, don't worry. Now, coming to, once you know that your income is chargeable under the head PGBP, what is the next step? The next step is computation of the PGBP income. Where it is written? It is written in section 29, and in a very simple manner. It is written that how to compute PGBP income. Section 29 says follow section 30 to 43D. If you follow section 30 to section 43D, you will come to know how to compute PGBP income. It is as simple as this. But before computing the PGBP income, you also have to maintain books of account. So how to maintain books of accounts? Every assessee has to maintain books of accounts. So it is written in section 145, and that's what we are going to see now. And in 145, there are 3 subsections. The first subsection says that if you are a PGBP assessee or if you are an IFOS assessee, either of the two heads, then you have to follow either mercantile system or cash system. Whatever you want to follow, you have both the option, but you have to follow regularly. You cannot change on a regular basis year to year. 1 year cash, 1 year mercantile, then cash, and you cannot do that. Regularly follow one of the method of accounting. Once you follow the mercantile system of accounting, then you have to follow the CBDT's accounting standard, and that is what? Income computation and disclosure standard, as per subsection 2, as you can see over here. And if you do not follow these 2 subsections, that is, if you do not follow regularly method of accounting, whether mercantile or cash, you have to follow regularly. If you do not do that, or if you do not follow the proper accounting standards mentioned by CBDT, that is the income computation and disclosure standard, then as per 145 subsection 3, the government has given the power to the assessing officer to do what? To do best judgment against you. Best judgment will be done against you. Okay. Now, there comes after this the entire structure what we are going to do in this chapter, that is the deductions first of all, and then we are going to do the disallowances. Okay, so I'll be talking about this obviously one by one, all the sections we are going to do. Coming to the special charging sections. So what does special charging section signify? Special charging section signify a very simple thing, that if something cannot be charged in the general charge, it will come in the special charge. Okay, like the first one, if I am giving you money, to not do any business or profession, I am saying you don't do this business and profession from tomorrow, I am paying you 200 crore rupees. If I am giving you money for not doing any activity in relation to any business or profession, that will also be chargeable in your hands as business and profession income under section 28(5)(a). And the person who is giving that money, I am doing interlinking here itself, and the person who is giving that money, that person is also liable for what? Deduction of TDS under 194J at the rate of 10%. So this is non-compete fees which you are paying to other person, so that that person should not compete with you. So if you make a payment of non-compete fees to any person, then in that case you have to deduct what? TDS under 194J at the rate of 10%, and that non-compete fees will be chargeable to tax as income of the other person. Next one, if you give any benefit or perquisite in business and profession to any person, Suppose you like the product of your supplier. So if you like the product of your supplier, so you are giving some gift or some benefit or perquisite to your supplier, that is also chargeable in the hands of the supplier. And now here also, if you remember in the chapter of TDS, we have done that. So when you make the payment, as when you give any benefit or perquisite to any person in business and profession, here also you are supposed to deduct TDS under 194R, a new section, a newly inserted section mentioned by the Finance Act 2022. 194R, you are supposed to deduct TDS at the rate of what? 10%. Let's talk about the third one, treatment of insurance. Generally, when you receive the money of insurance from the insurance company, it is exempt under 1010D, but that is subject to some condition. What is that condition? First thing is, you need to see when the policy was issued. If the policy was issued between 1st April 2003 to 31st March 2012, then your annual premium should not exceed 20% of sum assured. Then only it will be exempt, otherwise it is taxable. And if it is taxable, the insurance company will also deduct TDS under 194DA. Later on, we will see that. Second, if the policy is issued between just 1 year, that is 2012 to 2013, then your annual premium should not exceed 10% of sum assured. If your policy is issued after 2013, then your annual premium should not exceed 10% of sum assured for your normal person, and for disabled person, it should not exceed 15% of sum assured as mentioned over here. If it is within this limit, then only the amount received from the insurance company is exempt, otherwise it is taxable. For ULIP, there is a separate amendment which the government has made in Finance Act 2021, whereby they have said that your annual premium along with the percentage should not exceed the amount of 2,50,000 also in any year. So there the limit is not only in percentage, there the cap is not only in percentage but also on the amount. That we'll see later on in the chapter of capital gains, don't worry. Next, keyman insurance policy, what has to be done? Amount received under keyman insurance policy, if it is received by employer, then it is taxable under PGBP. If it is received by employee, then it is taxable under income from salary. And if it is received by the family members of the employees, that is nominees of the employee, then it is taxable under IFRS. So keyman insurance policy is taxable depending upon the recipient who is receiving it. Okay, according to that it will be taxable. Next, some points with respect to what? With respect to export related assessee. If I am an export related assessee and if I sell an import license and if I generate a profit out of it, that is a PGBP income as per section 28. If I get any custom duty drawback, or if I get some refund under customs, then that is also a PGBP income. If I get some cash incentive from the government for exporting certain products, if you export certain products, the government gives you cash incentive. That cash incentive is also your PGBP income. Moral of the story is very simple. If you find such income in your P&L account, let it be part of P&L, because these are PGBP income in itself, and therefore they should be chargeable under section 28 itself. Next one, last one. If you do any business contract with anyone, and if that business contract is either terminated or if it is either modified, for that if you are getting some compensation, then that compensation is also chargeable under the PGBP for termination or modification of a business contract. Be very careful. Here the profession contract is not covered. Profession contract is not covered. Only business contract is covered. It means if a business contract is terminated or modified and if the money is received, then it is taxable. If a profession contract is terminated or modified, then it is not taxable. Be very careful. Last but not least, if an employment contract is terminated or modified, then it is taxable under IFRS. So be very careful. If a business contract is terminated and modified, then it is chargeable under PGBP. If an employment contract is terminated and modified, then it is chargeable under IFRS. But if a professional contract is terminated or modified, then it is not chargeable anywhere. Just check it once. This completes our first chapter, that is charging section. Just go through it once and then we'll move ahead with the next one. Now let's move on to the deductions first, and in deduction also we are targeting the biggest one first of all, and that is depreciation. This is the biggest deduction under the entire income tax law, which is given under section 32, and in our book it is given in chapter 2. So what is given in this? First of all, we need to understand the types of depreciation. There are 4 types of depreciation which we need to understand. One is the normal depreciation under the block scheme, one is additional depreciation under the block scheme, one is SLM depreciation for power generating units, and one is terminal depreciation for power generating units. We are interested in the block scheme normal depreciation first. We are not interested in all these things as of now. Let's talk about a normal depreciation under the block scheme. Now to claim depreciation under the block scheme, you need to fulfill certain conditions. The first condition is the ownership criteria. If you want to claim depreciation under the income tax law, you need to be the owner of the asset. Sir, what do you mean by the term owner? Unfortunately, the term owner is not defined under the income tax law. But the Supreme Court in the case of Mysore Minerals Limited has defined the term owner. And what do you mean by the term owner as per that? The Supreme Court held that the term owner means a beneficial owner and not a legal owner, not legal owner. Registration, title, all of them are irrelevant to determine the ownership. What is relevant is the beneficial owner who is benefiting from the assets. That person can be considered as an owner. Now let's go ahead with the next part. That is, who will claim depreciation in case of lease transaction? So CBDT has said that in case of lease transaction, it is the lessor who is going to claim the depreciation. And who will claim depreciation in case of hire purchase transactions? The CBDT has again held that in case of hire purchase transaction, it is the hire purchaser. It is the hire purchaser who will claim what? Claim the depreciation, as you can see over here. Now, there was one very important Supreme Court judgment of ICDS Limited versus CIT, whereby the assessee was engaged in non-banking financial company and leasing company. Assessee was engaged in leasing cars. So when assessee leased the car, the assessee used to lease the car for long-term period of 5 years, 10 years, etc. And assessee used to earn leasing money out of that particular lease out. So now, in that case, the assessee was in the business of leasing the car. So in that case, the court held that the assessee would be eligible for getting the depreciation and not the lessee, because the assessee is into the business of leasing the car, and therefore the depreciation should be allowed to the assessee and not to the lessee. Okay. Next one. Next condition to claim depreciation is you need to use the asset for the purpose of depreciation. What do you mean by the term use? Use means actual use or passive use. Both use are covered. If you passively use something which is necessary for use, something which is necessary for business, something which is ready for use, can also be considered as what? Use for the purpose of income tax law. Then comes, if I am not able to use my asset because of some extraneous reason, because of some extraordinary reason, will I be getting the depreciation? The court has held that again. Chennai High Court, Madras High Court has held that if you are not able to use your asset because of some extraordinary reason like paucity of raw material, paucity of raw material means shortage of raw material, then you will get the depreciation because it was not your mistake to claim depreciation. Okay. Now, under income tax law, the depreciation is allowed on the basis of block. And what do you mean by the term block? The term block is defined under section 2 clause 11, and it is categorized into two parts: tangible asset, intangible assets. Intangible assets will include lot of assets, but from financial year 2020-2021, goodwill is no more an intangible asset. It means you will not get depreciation on goodwill anymore from financial year 2020-2021. Before that, goodwill was eligible for depreciation, but from 2020-21, goodwill is not eligible for depreciation. Be very careful. Now, let's talk about the tangible asset. Tangible assets are categorized by the government into four parts: plant, machinery, furniture, building. By default, plant and machinery will be depreciated at 15%, and building and furniture will be depreciated at 10% by default. And intangible assets will be depreciated at what? At 25%. All of them will be depreciated at what? At a WDV method. Now, there are certain special rates given for each and every case. Residential building will be depreciated at 5%. Temporary structure will be depreciated at 40%. Motor car will be depreciated at 15%. But if you are in the business of running the motor car on hire like Ola, Uber, etc., then in that case you will get depreciation of 30%. And in that also, if the motor car is purchased between 28th of August 2019 to 31st of March 2020, if you have purchased the motor car during that period, that is during this period, and you are putting to use during that period, then you will get 15% extra. It means where you are getting 15%, you will get 30%, and where you are getting 30%, there you will get 45%. But here also there is a catch which I am interlinking with later chapter. If you are following 115BAA, 115BAB, 115BA, 115BAC, 115BAD, those alternative tax regime, then in that case you cannot get depreciation of more than 40%. So here which you are getting 45%, now maximum over there it is 40% only, you cannot get more than 40% in that case. Computer and computer and its peripheral will be subject to 40% depreciation rate. There is something written in the bracket that will discuss in the chapter of international tax. Mobile phone EPBX will be depreciable at 15%. Windmill, professional books, aircraft, pollution control equipment, all four of them will be depreciated at 40%, and ships will be depreciated at 20%. Okay. Now, if I acquire an asset and if I put to use for less than 180 days in the same financial year, then it becomes half. So if I acquire an asset in 22-23 and if I put to use for less than 180 days in 22-23, then it becomes half. It means if I acquire in 22-23 and I put to use for less than 180 days in the next year, then next year it won't be half, it will be fully allowed to you. This is what I have put special emphasis in your classroom, if you remember. Okay. Then comes, there is no definition of furniture, building, machinery, nothing is defined, but plant is defined. How it is defined? Plant is defined in an inclusive and an exclusive manner. Plant includes what? Ships, vehicles, books, scientific apparatus, surgical equipments. Plant includes these 5 things, and plant excludes 4 things. That is tea bushes, that is livestock, that is building, and furniture and fitting are excluded from the definition of plant. Okay. Now, next, when you can claim depreciation under the block method, you have to fulfill 2 conditions. If you do not fulfill either of the 2 conditions, you will be liable for capital gains under section 50, that is short-term capital gains. Sir, which are the 2 conditions? On the last day of the financial year, your quantity column should not become 0, and on the last day of the financial year, your amount column should not become negative. You should have at least some assets in your quantity, and against that there has to be a positive value. Then only you will be getting the depreciation. If either of the conditions are not fulfilled, you will be thrown out of the chapter of depreciation and you will be thrown to the chapter of capital gains. You will be liable for short-term capital gains under section 50. Now, is it mandatory to claim depreciation? Absolutely mandatory. It is mandatory to claim depreciation. It is not on your wish. You have to claim depreciation irrespective of whether you wish to claim or you do not wish to claim. Next, sir, you said that income tax gives depreciation on WDV. Yes, sir. What do you mean by the term WDV? Is the term WDV defined under income tax law? The answer is yes. It is defined under section 43 clause 6. How it is defined? WDV means an actual cost of an asset as reduced by depreciation which is actually allowed to the assessee. Actually allowed means what? Which is actually reduced from the profit and loss account to reduce your taxes. That depreciation is called as actually allowed. But the government has made two exceptions to this definition. First, if there is an unabsorbed depreciation, definitely that is not actually allowed because you don't have sufficient profits to absorb that. That is the reason you are calling that as an unabsorbed depreciation. If there is an unabsorbed depreciation, then you carry forward to the subsequent year. But that is deemed to be actually allowed. It means if there is an unabsorbed depreciation in the current year, you have to reduce from the block of asset as per explanation 3 to section 43.6. Be very careful. These are slightly tricky points. If there is an unabsorbed depreciation, then you have to reduce from the block of asset to arrive at what? To arrive at your WDV. Second case, if your business is partially agriculture and partially taxable, it means you are earning exempt income also, you are earning taxable income also. But while computing the WDV of the asset, you will not do any segregation of depreciation. You will remove the entire depreciation from the block of asset, assuming that the entire depreciation is from what? Is from taxable business. You are not going to think at that time that this much is business, this much is exempt, 40% is taxable, 60% is exempt, so depreciation should also be segregated. No, 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 no. While computing the WDV, you will reduce the entire depreciation as if the entire activity is a business activity, entire activity is a taxable activity. This is what it wants to say. Next, as I have told you, from 1st April 2020, the government has stopped giving depreciation on goodwill. So what if there is already a balancing figure, a WDV pending in your goodwill on 1st April 2020? So the government has said that if you have purchased some goodwill in 2015-16 and you would have claimed depreciation on that in 15-16, 16-17, 17-18, 18-19, 19-20, till 19-20 it was allowed. So whatever is the remaining WDV, you have to reduce it from the WDV of the intangible asset as on 1st April 2020. So you have to reduce the old WDV also from the total intangible assets as on 1st April 2020 to claim depreciation in future year. Moral of the story is very simple. Government is not intending to give you depreciation on goodwill even which were purchased in the past years. Forget about which are purchased today. That will not be allowed only, obviously. Something which was purchased in the last year and included in the WDV, that shall also be reduced from the block of asset. Now coming to the next part, that is additional depreciation which is given under section 32 subsection 1 clause 2a. At what rate? It is given at 20%. Why it is given? To whom it is given? It is given to an assessee engaged in manufacturing or production of any article or thing, or assessee engaged in generation or distribution or transmission of power. So if an assessee is engaged in these two business, they will be eligible for additional depreciation. How much additional? 20%. What they have to do? They have to purchase and put to use new plant and machinery, new plant and machinery, new plant and machinery. So which plant and machineries are not allowed? Second-hand plant and machinery is not allowed. Or plant and machinery used in office, residential accommodation, guest house, ships, aircraft, road transport vehicle, not allowed. Any machinery which is subject to 100% deduction already in 3580 or in section 35 scientific research, that machinery will also not be eligible for what? Additional depreciation. Not allowed, not allowed, not allowed. Okay. Then comes, sir, will I be eligible to claim additional depreciation on forklift trucks? Yes, I have done one question with you all that on forklift trucks you can claim additional depreciation because forklift trucks are not considered as vehicle only as per Motor Vehicle Act. Therefore, you can claim depreciation on forklift truck. Sir, what if I purchase and put to use for less than 180 days in the current year? Then you will get 10% in the current year and balance 10% in the exactly next year you are going to get. Don't worry about it. So if you put to use the machinery for less than 180 days, 10% in the current year, 10% in the next year. Sir, will this additional depreciation also be reduced from the block of asset? Yes, additional depreciation should also be reduced from the block of asset, and it is a one-time benefit on one asset. If you purchase again next year, you will get again. If you purchase again next year, then you will get again. On one machinery, you cannot get every year. On one machinery, only once 20%. Okay. Last but not least, sir, if I am engaged in printing, will I be eligible for the benefit of additional depreciation? Yes. If I am engaged in printing and publishing, will I be eligible? Yes. If I am engaged in only publishing, then no. You should be engaged in either printing. You should be engaged in either printing and publishing both. If you are engaged in either of the two, you will be eligible for claiming additional depreciation under section 32 subsection 1 clause 2a. Okay. Coming to the next point, as we have done the discussion that WDV is the what? WDV is nothing but actual cost minus depreciation actually allowed. then in that case the question will arise, what do you mean by the term actual cost? So the term actual cost is defined under section 43(1) with lot of discussions which are going to come one after another. Let me start with the discussion one by one. First of all, the basic meaning of the term actual cost is what? Actual cost means actual cost of asset to the assessee as reduced by that portion which is made by any person or authority. So whatever is the actual cost of the asset to the assessee, you should consider that. Then reduce from that any portion which is made by some subsidy or grant or reimbursement given by some person or authority, you can reduce that. Okay. Secondly, when you purchase an asset and if you make a payment for an asset of more than 10,000 rupees to a person in a day, if you make a payment of more than 10,000 rupees to a person in a day, then in that case you have to make the payment by account pay check, account pay draft, ECS or such other electronic mode. Otherwise that asset shall not form part of what actual cost. Moral of the story is very simple. If you make the payment of more than 10,000 by other than these four modes, then that asset will not be eligible for what? Depreciation, depreciation, depreciation. What if I take a loan to buy an asset? It's very simple. If you take a loan to buy an asset, you can do that. But till the time the asset is put to use, you will capitalize the interest to the cost of asset. And once the asset is put to use, you will take that interest to what? To your P&L account, the way you do in your accounting standard. Okay, it is as simple as that. Now there are certain tangible fixed asset ICDS which are mentioned over here, which says that if certain expenses which are not related to the tangible asset, that do not make it part of asset, if it is related and attributable to the project or cost of asset, then you should include that as a part of asset. Suppose if there are some expenses which you incur on startup or commissioning or say testing of the project, then in that case it should be capitalized to the cost of asset. But once the expenses are incurred after the commercial production started, it means your business is started, it means your production is started, it means your assets are starting to use, then after that you should treat those expenses as what? As your revenue expense. It is as simple as that. Coming to the next point, borrowing costs. Because we are talking about the interest cost, we have to talk about borrowing costs. So if you take a loan for the purpose of asset, then what has to be done with that borrowing cost? So the government has given an ICDS specifically for that, and the government has said that if you have incurred a borrowing cost specifically for qualifying asset. What do you mean by the term qualifying asset? Qualifying asset means an asset which takes a substantial period of time for it to be ready for its intended use. That asset is called as a qualifying asset. So the government has said that if you have taken a loan specifically for qualifying asset, then you have to capitalize that. But if the loan is general, it is not specifically for qualifying asset, then you have to capitalize as per this formula. A into B divided by C. It's very simple. I have taken a 10 lakh rupees loan specifically for qualifying asset. Then whatever interest is there, then I capitalize that. I have taken a 10 lakh rupees loan generally for other business activity also, for payment of salary also, for payment of other dues also, and for the purpose of purchasing qualifying asset also. I do not know how much has gone where. Then in that case, you have to follow this formula. What is this formula? A and C is going to be stagnant, but B is going to be variable. B is going to change with time. What is A? A is your interest cost, borrowing cost other than the specifically borrowing cost. It means A is your general borrowing cost. And what is your C? C is your total of the balance sheet average. Whatever is the balance sheet total in the first year of the financial year, and on the last day of the financial year, you have to take the average of that. So A and C is very clear. What is B? B differs from time to time. B has three categories. First, you have to take the opening and the closing balance average of the qualifying asset. If the qualifying asset is there in the balance sheet on the first day also, and it is there in the balance sheet on the last day also, then you have to take the average of the first day and the last day. That will become B, and you will get the proportion how much has to be capitalized. Second, in case the qualifying asset does not appear in the balance sheet on the first day, it means the asset was not there on the first day. It started from the middle of the year, say from the month of June it started, or it does not appear in the balance sheet on both. That is not appearing in the balance sheet on the first day also and the last day also. It means it started in June and completed in December. So in that case, what has to be done as B? What should I take as B? You have to take the half of the cost of the qualifying asset as B. And the third case, if it does not appear in the balance sheet on the last day, it means it was appearing in the balance sheet on the first day. Then you have to take the value on the first day, and on the day on which the asset was put to use, you have to take the average of that particular thing. Suppose on first day the value of 10 lakh and in December it was put to use. On that day the value was 15 lakh. Then you have to take the average of 10 lakh and 15 lakh, and that will become your B. And once the asset is put to use, it means if it is not a qualifying asset, then you have to claim that expenditure of borrowing cost as what? As your revenue expenditure under section 36, subsection 1, clause 3, as you can see over here. Okay. Now, this is not where the explanation, this is not where section 43(1) ends. The 43(1) has lot of explanations given below it, out of which few explanations I am going to keep pending as of now. That is the first and the second one. I am starting with explanation 2 as of now, because the first and the second one is going to be dealt with some other provisions later on. Okay. So the first thing which I am discussing today is, which I am revising today, is explanation 2. Explanation 2 talks about what? When you receive an asset by way of a gift or by way of an inheritance from someone, or even by way of will, then what will be the actual cost? Then in that case, the actual cost will be the actual cost in the hands of the previous owner minus the depreciation which is allowed to the previous owner. So in that case, the actual cost in your hands will be the actual cost in the hands of the previous owner minus the depreciation which is actually allowed to the previous owner. That means the WDV in the hands of the previous owner will become your actual cost. Third point, what will happen if you sell a asset at a higher price to someone? Suppose this is a phone. This is a phone which I am selling to someone for 10 lakh rupees. Now the worth of this phone is say 1 lakh rupees. So I am selling that for 10 lakh rupees. So this, if you sell any asset for a higher price to claim higher depreciation, then in that case, the actual cost will be determined by the assessing officer with the prior approval of Joint Commissioner. So assessing officer will take the prior approval of Joint Commission and will determine what? The actual cost. Next, what if Mr. A sells the asset to Mr. B, then Mr. B sells the asset to Mr. C, and then Mr. C again sells the assets to Mr. A. So if I sell the asset and then I reacquire the same asset after few years, then what will be the actual cost? Then the actual cost, the government says that WDV at the time of original transfer, when Mr. A sold to Mr. B, what was the WDV at that time? Compare that what with when Mr. C sell that to Mr. A. When you reacquired the asset at that time, what price you have reacquired the asset? Whichever is lower will be considered as your actual cost. So if A sells to B and B sells to C and then C again sells to A, the WDV at the time when A sells to B will be compared with the price at which the C sells to A. Whichever is lower will become your actual cost. See here. Next one. I am A, you are B. You have bought some asset for 1 lakh rupees. Okay. And now you are selling that asset to me. After I bought that asset from you, I again lease back that asset to you. Now, what will be the actual cost of that asset in my hands? So, in that case, the government says that whatever is the WDV in the hands of your hand, that will become my actual cost. Again, I am saying this is a complicated one. Explanation 4A. I bought an asset from you. Now, after I bought an asset from you, I gave that asset to you only on lease. So, in that case, what will be my actual cost? Whatever is your WDV, that will become my actual cost. This is what this explanation 4A has to say. Next, explanation 5. Here, there are two things. Plant, machinery and furniture, there is a different provision, and for building, there is a different provision. If I convert my personal plant, personal machinery, personal furniture into a business, what will be the actual cost? The government says that there is no explanation. The actual cost will remain actual cost. If you convert your personal plant, personal machinery, personal furniture into a business, the actual cost will remain actual cost. Now, the second question is, if I convert my personal building into a business building, then what will be the actual cost? Then the government says that there is explanation 5, which says that if you convert your personal building into a business building, then actual cost will be the cost of the building or the cost of construction of the building minus notional depreciation for over the years. Sir, which rates depreciation you will take? Current year depreciation rate you will take for all the years. That is the year in which you are converting. That year's depreciation rate will be taken for all the years. This is what it is written over here. Then explanation 8 is very simple. Once the asset is put to use, after that whatever is the interest cost that shall not form part of the asset, that will go to what? That will go to the P&L. Once the asset is put to use, then interest cannot form part of the asset. It has to go to the P&L account. Okay, next. If you have claimed GST credit on any asset, if you have claimed input credit on any asset, then on that GST credit you cannot claim depreciation. You have an option. In fact, you bought an asset. If you claim GST credit, then you cannot claim depreciation on that credit portion. You have to claim depreciation on other than the basic price. You can claim depreciation. But if you have not claimed the GST credit, then you can claim depreciation on the entire amount, including the GST portion. Is it clear? Please say. Next, explanation 10, which says that if someone gives you subsidy or grant or reimbursement, then you have to reduce that much portion from the cost of the asset. So if somebody is giving you subsidy, grant or reimbursement to buy an asset, then that much has to be reduced from the cost of asset. Now, if somebody is not giving you directly subsidy, grant or reimbursement for a particular asset, but they are giving for a project in which you are going to buy a lot of assets. So if your project cost is 150 crores and there will be a lot of assets in that, and if somebody is saying that we will finance you 20% of that, then in that case you have to reduce 20% from every asset. Every asset. And out of that 150 crores, suppose you have bought 5 assets, then you have to reduce 20% from every asset that you see over there. Is it clear? Proportionately from every asset, that is what it is written over here. I have given you example also in class. I make you write that example also in class. Okay. And last explanation as of now, I am not saying that explanations are ended. There are some explanations which will come later on, like explanation 12 is going to come. Explanation 13 is also going to come later on. We'll be dealing with that also after some time. After some lectures, maybe in today's lecture or maybe in the next revision video. Explanation 11 talks about what? If a non-resident brings an asset to India, for what? For business purpose, then what will be the actual cost of that asset? A non-resident was using an asset outside India. Now he is bringing that asset to India. Then what will be the actual cost of that asset? The government says that the actual cost of that asset will be the actual cost minus the depreciation over the years. whatever depreciation he could have claimed over the years, reduce that, whatever is the leftover amount, that will be considered to be what? The actual cost in the current financial year on which he can claim depreciation in India. Just go through it once, okay? Next. The government in Finance Act 2015 has made a very important amendment in section 222(4)18, and they have said that in the definition of income, we are inserting few things. I said what? They say that if you receive any subsidy, grant, or cash incentive, or duty drawback, or waiver, or concession, or reimbursement by whatever name called, by these authorities. Who are these authorities? These are governmental authorities. If you receive these items from central government, state government, any body, any agency, any authority, then it is taxable as your income. It is your income. Now I have a question. The question is, what if I receive subsidy? What if I receive grant, or what if I receive a reimbursement for a fixed asset? Then also it is income, because then it will clash with your own provision. Here it is written that if you receive subsidy, grant, or reimbursement, then it should be reduced from the cost of asset. Then what shall I do? So in that case, the government has excluded that portion from here. It means if you get a subsidy, grant, or reimbursement for a fixed asset from central government, state government, body, agency, then you have to reduce from the cost of asset. Do not consider that as an income. Apart from that, if you receive any other subsidy, or any other grant, or any other reimbursement, or if you receive waiver, or if you receive what reimbursement, or if you receive duty drawback or concession, then it is always income. So be very careful. The subsidy, grant, and reimbursement which is covered in explanation 10 will remain there only. It means it will not be considered as income. It will be considered to be part of what? Explanation 10, and you have to reduce from the block of asset. Second, if any subsidy is given by central government to two people, to central government trust or to state government trust. So if a subsidy is given by central government to a central government trust or to a state government trust, then that also is not taxable. And the third thing, if a subsidy is given for the individual benefits of the citizens of this country, like LPG subsidy or other welfare subsidy, like education subsidy, etc., given by the government to individuals for their personal benefit, not for business and profession, then that is also excluded. That will also not be considered as what? As an income of the assessee. And last but not least, here we have done some conclusion that if the subsidy is for fixed asset, then reduce from cost of asset. And if the subsidy is for any other purpose, and if it is received from central government, state government, any authority, body, agency, then you consider that as what? As your income. But if the subsidy is given by a company, then it is not taxable. Why it is not taxable? Because in 224(18) it is very clearly written here that the subsidy has to be given by central government, state government, body, agency, authority, not company. Company is not mentioned over here. It is not written over here any person. If any person would have been written, then the even government, etc., would have come over here. Okay, so be very careful about it. So if the subsidy is given by these 5 people, then it is taxable. If the subsidy is given by company or firm or LLP, then it is not taxable even today. Be very careful. Now there is one ICDS which the government has made, that is ICDS VII, Government Grant Recognition of Government Grant. Now what does this ICDS has to say? The first thing this ICDS says that when to recognize the government grant. It says that do not recognize until you are reasonably sure that you will fulfill all the conditions. Once you are sure that you will fulfill all the conditions, then recognize. And secondly, until you are reasonably sure that the government has not made a false commitment, they will actually give you the grant, that you will receive the grant. Once you have these two satisfactions, that you will fulfill the conditions and the government will also give you the grant, only then recognize, do not recognize. Second thing, once you receive the money from the government, then there is no sense of postponing, then you have to recognize, that's it. Okay. Now the second question is how to recognize. Treatment. It's very simple. If it is related to depreciable asset, then reduce from the cost of asset. If it is related to lot of depreciable assets, not one asset, then reduce proportionately. It is as simple as that. If it is related to what? Some compensation, then it is chargeable. Suppose sometimes government gives you some kinds of compensation, etc. Okay. So in that case, it will be chargeable in the year in which it is receivable. It is receivable. If it is in relation to some balancing figure not covered in 1, 2, 3, 4, then you have to recognize as per matching concept, that is as per your accounting principle. Now, if it is related to some non-depreciable asset, then you have to recognize over the same period during which you fulfill your commitment. Now, subsidy is given for some commitment. Suppose government is giving you subsidy for what? For providing free books to students across country. So the government is giving you subsidy. So as and when you will provide free books to the students across country, you have to recognize the subsidy. So that's what law says. As and when you will fulfill the commitments, you have to recognize the subsidy. Now what? What if you do not fulfill the commitment and you have to give refund to the government? Then what will happen? Then also the government has given the treatment. In case of depreciable asset, when you receive the subsidy, what you did? You reduce from the block of asset. Now if you are giving the refund, what you are supposed to do? You increase again back to the block of asset. As simple as that. Yes or no? And in case of the other 3, this is slightly tricky. Suppose you receive 100 crore from the government. Okay. And now you have fulfilled the commitment of 30 crore. So the balance credit is how much? 70 crore. Now the government is saying, no, we want 100 crore back because you have not fulfilled your commitment. We want 100 crore back. So what you will do? 70 crore, you will adjust. You have to give refund 100 crore back to the government. So 70 crore, you will adjust against the unamortized credit. and 30 crore you will charge to PNL because that is your loss that you have to bear it from your pocket. This is what this point has to say. I have also given you example based on this. So whatever is the balance credit, you have to first adjust the refund against that, and if over and above, if you are giving some refund, then that is your loss. Your charge is that to PNL account and claim that as an expense. Just check it once. Is it clear? I hope it is clear. Not very important for exam. Coming to the next point, that is unabsorbed depreciation. Section 32 subsection 2. This talks about unabsorbed depreciation. Sir, what is unabsorbed depreciation, sir? Unabsorbed depreciation is a depreciation which cannot be absorbed in the current year's profits because there are no sufficient profits. So what has to be done with that? You can carry forward that till infinity. There is no time limit, and you can carry forward and set off against what? First against PGBP and then against any income except salary. Don't set off against salary. Apart from salary, you can set off against any other rate of income. Priority of set off should be what, sir? If in the exam they have given you a lot of things, then always take the set off of first of all current year depreciation because that is mandatory to claim as per explanation 5 to section 32(1). Then you have to take the brought forward losses because that will expire after 4 to 8 years. Then you are supposed to take what? Unabsorbed depreciation because that is allowed till infinity. This has to be your priority set off. In bracket there is something written. You will understand that after 1 or 2 hours. You will understand that. Don't worry. Okay. Next, how to claim depreciation in case of amalgamation, in case of amalgamation, in case of demerger, in case of succession. Sir, amalgamation and demerger we understand. What do you mean by the term succession? Succession means a firm is getting converted into a company or an individual is getting converted into a company. That is known as succession. You will learn that in the chapter of capital gains, what exactly succession is in section 4713, 4714, 4713A, 13B, etc. There you are going to learn the topic of succession. Now, coming to the discussion of PGBP today now. How to claim depreciation in case of amalgamation, demerger and succession? So for that, the government has made a proviso under section 32 subsection 1 which says that in case of amalgamation, demerger, succession, compute depreciation as if no amalgamation, as if no succession, as if no demerger has happened. First compute as if nothing has happened. Once it is computed, then bifurcate between the amalgamating company and the amalgamated company, the demerged company and the resulting company. On the basis of number of days the assets are used by them. For more information, you can refer this question. Okay. Later on, one very important question will arise. What will be the actual cost in the hands of the amalgamated company? Because the assets are getting transferred from amalgamating company to amalgamated company after amalgamation. So what will be the actual cost in the hands of the amalgamated company? For that, the government has made two explanations which says that surprisingly, the opening WDV in the hands of the amalgamating company will become the actual cost in the hands of amalgamated company. The opening WDV in the hands of amalgamating company or the actual cost in the hands of amalgamating company will become the actual cost in the hands of amalgamated company. Sir, will that not lead to dual deduction? Yes, it will lead to dual deduction. So be it. The government is here giving that dual deduction knowingly. Knowingly, they are giving it to encourage what? Amalgamation. So whatever is the opening WDV in the hands of amalgamating company, that will be given to the amalgamated company as what? As an actual cost. Be very careful. Next, let's talk about what? SLM depreciation. First of all, let me tell you, SLM depreciation is only for assessee engaged in power generation or power generation and distribution. And there is one drawback of this depreciation. This depreciation is an option for you. If you want to take, or you can go for WDV. Now, why there is a drawback of this particular depreciation? Because if you go for this depreciation, then you cannot claim additional depreciation. Be very careful. So, if you want to claim additional depreciation, then you have to go for the block of asset concept. Block of asset concept can give you the benefit of additional depreciation, but SLM depreciation will not give you the benefit of what? Additional depreciation. This is one of the drawbacks that you have to bear it. Then the choice is yours, whatever you want to do. Now, how to claim depreciation? Very simple. SLM is the most simplest method in the entire world. 1 lakh rupees asset you bought, rate is 10%, you will claim 10% every year, 10,000 every year. So after 3 years, you would have claimed how much? 30,000 depreciation. Here, till here, everything is very simple. From here, the real journey starts. Now, suppose after 3 years, the WDV is 70,000. Now, suppose if I sell that for less than WDV, then what will happen? The government says that if you sell for less than WDV, then the differential amount of 20,000 we will give you as deduction, and it will be called as a terminal depreciation. Terminal means depreciation which is at the end of the asset. Now, at the same time, principle of equality, if you sell for more than 70,000, that is if you sell for more than WDV, then we charge 10,000 rupees as your deemed income, and technically this is called as balancing charge under section 41 subsection 2. And now, if you sell for more than WDV and even more than cost, then the difference between the cost and the WDV, which is the depreciation, that much will be the balancing charge, and the difference over and above the cost, that is over and above 1 lakh rupees, that will be considered as your capital gains. Be very careful. If you sell for less than WDV, terminal depreciation. If you sell for more than WDV, balancing charge. If you sell for more than even cost, then entire amount is not balancing charge. Up to cost, it is balancing charge. 70 to 1 lakh, balancing charge. Above 1 lakh, it is capital gains. Be very careful. Now, in this case, the government has said that the capital gains have to be computed in a very special manner, and it is so special that if there is a loss coming, then the capital gains will come to zero. If there is a profit coming, then the capital gains will come to capital gains. So they have made a very unique statement. They have made a very unique provision whereby if there is a loss, then the capital gains will come back to zero. How, sir? The government says that you have to compute capital gains as per section 50 capital A. Sir, how? Sale consideration minus cost of asset. Sir, how? But don't take cost of asset as 1 lakh rupees. No doubt the cost of asset is 1 lakh rupees, right or not? 1 lakh, no, it is original cost, but don't take 1 lakh. You have to take adjusted WDV as cost of asset. That is 70,000 WDV plus balancing charge, if any, less terminal depreciation. This amount will become your adjusted WDV. Once you substitute the amount over here, in case of loss, the first case there is a loss, you will get no capital gains. The second case also there is a loss, you will not get any capital gain. In third case there is no loss, you will get capital gains of 20,000. You can test that. I have made you do in class. So you have to apply this formula. This is your revised cost of acquisition. Your cost of acquisition is not 1 lakh rupees. You have to take 70,000 plus balancing charge, if any, plus minus terminal depreciation, if any, then that will become your actual cost, and then you will compare that with what selling price, and then you will compute what your capital gains. Be very careful. The moral of the story I have told you, in case of loss you will come to 0, in case of profit you will come to positive amount. Last but not least, here general note for your knowledge, that by default in the year of sale you do not get any depreciation. Be very careful. Whenever you sell an asset, you do not get any depreciation under the income tax law by default. But be very careful. If there are two exceptions where the government is giving you depreciation in the year of sale. First is terminal depreciation. Do you agree to this? The terminal depreciation is one of the exceptions where you are getting depreciation in the year of sale. And second is amalgamation and demerger, where the amalgamating company and the demerged company is proportionately getting the depreciation under the income tax law. Is it clear? Let's come to the one last point of this chapter, and that is section 43A versus section 43AA. First, I'll be talking about 43A and then I'll be talking about 43AA. Sir, what is 43A? When 43A is applicable? Listen to the conditions. I'm counting on my fingers. 43A is applicable when you import an asset from outside India and there is a foreign currency loan on that. So if there is an imported asset, along with that there is a foreign currency loan, then 43A is applicable. Now the law says that 43A says that the whatever gain or loss comes on the date of payment, not on the balance sheet date, not on the balance sheet date. In 43A you don't have to see the balance sheet date. Whatever gain or loss comes in the date of payment, on the date of payment, that has to be adjusted not in the P&L account but in the WDV of the block of asset. So if there is a loss coming on payment, then you have to add back to the block of asset. If there is a gain coming on payment, then you have to reduce from the block of asset. This is what I have made you write in the class. You can go and see the example in the class. Okay, so imported asset, foreign currency loan, then you have to follow 43A, and as per 43A you will adjust the gain or loss in the WDV of the block of asset on the date of payment, not on the date of balance sheet. Be very careful. Now what is 43A AA? The 43AA is a very recently inserted section 3-4 years back, which says that other than 43A, it means other than this, all other gain and losses will be computed as per ICDS, and ICDS says very simple thing, what your accounting standard says. You have to recognize on 31st March and then you have to again re-recognize on the date of actual settlement. It is as simple as that. So ICDS says the same thing what your accounting standard says. So first recognize on the date of transaction, then on 31st March reinstate, recognize the accrual profit or loss, and then on actual settlement again accrue, again find out what is the settlement profit or settlement loss, and then take it down to the P&L. So what all things can come over here? These are some of the examples which can come over here, as you can see over here. And then there is one ICDS over here which says the same thing, nothing great as such, that the by default you have to initial recognition should be on the date of transaction. Okay, but if there is a fluctuation, you can also take an average rate for a week. Instead of daily recording the transaction, you can take an average rate or weekly rate or monthly rate. But if there is a significant fluctuation during the month or during the week, then you take the rate on the date of transaction. Then again, on the date of last day of the previous year, you have to reinstate your profit and loss account as per what? As per the increased value of rate or decreased value of rate. The way you exactly do in accounts, you have to do the same thing over here. There is nothing great over here. Okay. So this is what your depreciation is all about. So just go through it once and then we'll move ahead with some more deduction. This was the biggest deduction out of all the deductions that we have to do in this chapter. Okay, just go through it once and then we'll move ahead with the next one. So after this, let's go ahead with the next thing, and there are some small deductions which we are going to do one by one. Let's see section 30 first of all. Section 30 talks about some expenses with respect to building, that is rent, rates and taxes, repairs and insurance with respect to building which is used for business and profession. Now it's very important to understand that if you're an owner, you're going to get the deduction of rates and taxes, repairs and insurance. But if you're a tenant, you will get deduction of rent also. Owner cannot get the deduction of rent now, because owner himself is the owner. He cannot pay rent to himself. Okay. Now, there are some important points which you have to keep it in mind, that repairs have to be revenue repairs and revenue repairs. It cannot be capital repairs. Okay. Rates and taxes will be allowed as deduction on actual payment basis as per section 43B. If you take deduction, if you want to take the deduction, you have to make the payment. Otherwise, you are not going to get the deduction. Secondly, if you want to insure your building, you pay insurance premium. You will get the deduction of insurance premium also. Now, last thing but not least, repairs. What you said about repairs, sir? The repair has to be revenue repair, not capital repair. What if the owner does a capital repair to its building? Then it will be allowed as a depreciation on that particular capital repair. What if the tenant does a capital repair to the building of the owner? If the tenant is doing a capital repair to the building of the owner, which is very strange but possible. So in that case also the government has said that the tenant will be considered as deemed owner and he will be given the deduction of what? Depreciation on that amount. Don't worry about it. Okay. He will be given the depreciation on that amount. He will be considered as a deemed owner of that particular building. So if an owner does a capital repair, he will get depreciation. Even if a tenant does a capital repair, he will also get the depreciation under the income tax law. Don't worry about it. Okay. Next. This is a very important point. You will find out this particular point in one of the adjustments in your questions, and that is what? Suppose if there is an agreement between the tenant and the owner that the repairs will not be undertaken by me, it will be undertaken by that owner only. And still in that case, if the repair is done by the tenant, then what will happen? In the agreement, it is written that the repair will be done by the owner, but still it is done by the tenant. Then what will happen? Then you will not get deduction under section 30. So the code says that then in that case you have to go to section 37(1). You have to fulfill the conditions mentioned in 37(1), and then you can claim the deduction under section 37(1), but you will not get the deduction under section 30 at all. Okay. Coming to the next one, which is on plant, machinery and furniture. If you do a repair and insurance of plant, machinery and furniture, you will get deduction under the income tax law under PGBP, and the repair has to be again a revenue repair, not a capital repair. Now be very careful. One thing is not covered over here. If you take a plant, machinery or furniture on rent, then the rent is not allowed as deduction over here. That will be allowed under section 37(1) subject to conditions mentioned over there. Now then there are certain small deductions over here, that if you pay insurance premium to secure your stocks, you will get deduction. If you pay health insurance premium of your employees, so employer is paying health insurance premium for employees, then it is allowed as deduction, but only what? Other than cash. It has to be other than cash, otherwise it is not allowed. You have to make the payment by other than cash, then it is allowed. Then bonus and commission paid to employees. So again the bonus and commission will be allowed on actual payment, not on accrual basis as per 43B, because 43B covers bonus and commission paid to employees. Here the government says that the bonus and commission should not represent profit. It means what? Suppose some of the employees are your shareholders, okay, and now to that employees who are shareholder, you are paying bonus instead of dividends. So instead of dividends you are paying bonus, then that shall not be allowed as deduction. Dividend is a separate thing, bonus is a separate thing. So you have to pay bonus over and above the dividend. So if instead of paying the dividends you are paying bonus, then it shall not be allowed, because that is the appropriation of profits, and that shall be disallowed under the income tax law. Next one is 36(1)(3), interest on borrowed capital. What does it talks about? It talks about deduction of interest on borrowed capital. You have to borrow money, you have to use that money for the business and profession, and you have to pay interest. Then only it will be allowed as deduction. So what am I supposed to borrow? You are supposed to borrow only money and money. Anything else, if you borrow, you will not be allowed to deduction, and there has to be an element of refund. You have to refund also that particular money. Where shall I use the money? You should use the money for the purpose of business and profession, and the word used for the purpose of business and profession is a very wider word. You can use for the purpose of payment of salary, you can use for the purpose of day-to-day operation, you can use for the purpose of buying even assets. Even assets you can buy from that asset, but once the asset is put to use, then only it is allowed as deduction. Till the time the asset is not put to use, you will not be allowed a deduction. The interest has to be capitalized to the cost of asset till the time the asset has not put to use. Next, does the AO has the right to dictate the rate of interest? At which rate of interest I should borrow the capital? No, the AO does not have the right to dictate the rate of interest. The rate of interest will be decided between the assessee and the lender. Yes, the AO has the right to dictate rate of interest only if the loan is taken from the related party and you are making excess payment, excess than fair market value, then the AO can interfere in between. Okay. Next, a Supreme Court judgment of SA Builders and Reebok India, Delhi High Court's SA Builders Supreme Court, whereby it was held that if I take a loan and if I give that money to sister concern and sister concern is using that loan for the purpose of business and profession, then I should get the deduction. But if I take the loan and if I give that loan to my sister concern and sister concern is using for the personal purposes of the directors, then I should not be getting the deduction. So when you give loan to your, when you divert the funds to your sister concern, you have to look into the facts and circumstances of every case, what exactly the sister concern is doing with that money. If the sister concern is also diverting that fund for personal purpose, then you will not get the deduction. But if the sister concern is giving that loan for the purpose, is using that loan for the purpose of the business of the entire group, then you should be allowed the deduction under the head PGBP. It should not be disallowed to you. Next, what if I take a loan for the purpose of paying income tax? Not allowed. Income tax payment, if you take a loan, then interest is not allowed. What if I take the loan for the purpose of payment of GST? Allowed. Why, sir? GST is a business payment and income tax is a personal tax. Therefore, it is not allowed. Okay. Next, what do you mean by the term interest, sir? Is the term interest defined under income tax law? Yes, the term interest is defined under section 2 clause 28A, which says that interest includes not only interest payable but also any other service charge or service fee in relation to money borrowed. So if you pay any other service charge, service fee in relation to money borrowed, it will be considered as what? It will be considered as an interest. Now there is a very interesting case law over here of Gujarat Guardian Limited, Delhi High Court, whereby the assessee took a loan from an IDBI, which is a public financial institution. Now after taking the loan, after some years, the assessee went to the bank and made a payment of lump sum prepayment premium, say of 10 lakh rupees. And assessee said to the bank that take this 10 lakh rupees and reduce my rate of interest. The bank said that, okay, we will take this 10 lakh rupees and we will restructure your loan and we will reduce your rate of interest. Now the assessee asked the deduction of this 10 lakh rupees. The assessing officer said that I will not allow you the deduction of 10 lakhs in one shot. The assessing officer said that I will allow you the deduction of this 10 lakhs over the life of the loan. And the life of the loan was surprisingly 10 years. But the assessee insisted that, no, I want the deduction of this 10 lakhs in one single year itself. That is the year in which I am making the payment. The contention which the assessee was raising was, the assessee was saying that this one-time payment, this one-time lump sum prepayment premium can be called as any other service fee or service charge in relation to money borrowed. Therefore, this lump sum prepayment premium can be called as what? As an interest. And because it can be called as an interest, and if this is an interest which is paid to a public financial institution, IDBI, it should be allowed on actual payment basis under 43B, and therefore it should be allowed to the assessee irrespective of the method of accounting. The assessee was raising a contention. This money which I am paying is nothing but an interest only as per section 228A, and because it is an interest and it is paid to a public financial institution, it should be allowed on payment basis or not on what? Accrual basis. Okay. Now let's move on to the next one. Next one is a discount on zero coupon bond. Now what this deduction is all about. Suppose I am a company, you are an investor, and I am issuing you bond at a discount. That is, I am issuing you bond at 50 rupees. That's it. And I will be redeeming you at 100 rupees. So this 50 rupees is my cost because I am issuing at 50, I will be redeeming at 100. So this will be cost for me, okay, and that is a discount which is a cost for me, and for that the government will give me deduction under section 36 subsection 1 clause 3A. Now be very careful. Suppose there are 10,000 bonds which I am issuing, so therefore my total discount will come to how much? 5 lakhs. So now the question is, how will I get the deduction of this 5 lakhs? So the government says that you will get the deduction of this 5 lakh over the life of the bond. Now how to compute the life of the bond? The government says that do not compute the life of the bonds based on number of years, but compute the life of the bonds based on number of months. So from this date till this date, that is from the date of issue till the date of redemption, you are supposed to compute the number of months which are there. Now in that also there is one catch which you have to keep it in your mind. If in a particular month there are more than or equal to 15 days, you have to consider that as a complete month, and if there are less than 15 days, you have to ignore that month and you should not count that as a part of your period. So in this case, you are issuing the bond on 30th of September. So from 13th September to 30th September, there are more than or equal to 15 days. So you have to consider September, October, November, December, Jan, Feb, March. So there are 7 months in the first year, and now for the next 4 years there will be 12 months, 12 months, 12 months, 12 months, and in the last year, April, May, June, July, August, 5 months in the last year. September you have to ignore because 12 September is less than 15 days, so you have to ignore that month. So like that, the total number of months from this date till this date comes to how much? 60 months, and 60 months you will divide it by what? By divided by 5 lakhs, you will get 8,333 rupees as your per month discount, and then you will multiply in the first year by 7 months, and then 12, 12, 12, 12, and last year you will divide by 5 months, multiply by 5 months, and then you will get the total deduction under the income tax law which you are eligible to claim. Okay, next few deductions are extremely important deduction. The first one is employer contribution to recognized provident fund, superannuation fund, which is allowed as deduction to the employer but subject to 43B. It means it will not be allowed on accrual basis, it will be allowed on payment basis, and you have to make the payment till the due date of filing of return as per 43B, because in 43B the due date is due date of filing of return. Second was employer contribution to certain approved pension fund. Here also you will be allowed the deduction subject to 43B, but here is a ceiling, there is a cap that your contribution should not exceed 10% of your salary. Salary means what? Basic and DA in terms. Suppose if your basic and DA in terms is 30 lakh rupees, therefore your contribution cannot be more than 3 lakhs. If it is more than 3 lakhs, then you will allow the deduction only up to 3 lakh rupees, not more than 3 lakhs. Third one, employer contribution to certain approved gratuity fund. Again, employer will be getting the deduction of this gratuity fund payment if they make the payment to the government on or before, if they make the payment to the gratuity fund on or before the due date of filing of return, subject to 43B. Now fourth one is a different one, employee's contribution, which is deducted by employer from the salary of the employee. That is also allowed as deduction to the employer. But what happens when I deduct? That is first considered as an income of the employee, and then the employer now has to pay that not by due date of filing of return, but employee contribution has to be paid faster by 15th of the following month. Be very careful. These three can be paid till the due date of filing of return, but employee contribution has to be paid by the next month 15th. By 15th of next month. If you do not make the payment by 15th of next month, you will not be allowed the deduction under the income tax law. Next one, allowance for animals. If you buy some animals other than stock in trade, if you buy the animals as stock in trade, then you will be allowed a deduction as a purchase cost. But if it is other than stock in trade, then you will be allowed the deduction under section 36(16) as what? As not in the year of purchase, but in the year of sale, or the year in which they became useless and you are selling their carcasses. So year in which they became useless. Suppose you bought the animal for 1 lakh rupees today, and now after 5 years they are sold for 30,000 rupees because they are dead or they have become useless. So the differential amount of the cost and the sale value, what is the cost? 1 lakh. What is the sale value? 30,000 rupees. The differential amount of 70,000 will be allowed as deduction in the year of sale or the year in which the animal become useless. Just check it once. Now let's move on to the next one, which is very important, 3617, which is talking about deduction of actual bad debts. Provision for bad debts are not allowed as deduction under income tax law. Yes, for certain banks and NBFCs, provision for bad debts are allowed as deduction under section 3617A, but here it is not allowed. Okay. Now to claim bad debts, actual bad debt deduction, you have to fulfill two conditions. First is you have to write off that debt in the books of accounts. In the books of accounts, you have to write off that debt. And secondly, the debt which you are writing off should have been taken into income earlier. It should have been taken into an income earlier. But for money lending and banking business, this condition is not applicable, because for money lending and banking business, their loan amount, their principal amount can never form part of income earlier, because principal amount which they give as a loan will always be forming part of the balance sheet asset side. So in that case, their loan amount is also written off. Now that is also written off. Interest is written off. Along with that, loan is also written off. So for banking business, this particular condition is not applicable. For money lending business, only condition one is applicable. They have to only write off. Okay. So the first condition, you have to write it off in the books of account. The second condition is it should be taken into income earlier. And for loan, for bank and lending business, this second condition is not applicable. Okay. Sir, is it necessary to prove that the debt has become bad? The court has said that no, you don't have to prove all those things, that the debt has become bad, that we are not able to recover, we have put all the efforts. You don't have to do all these things. You have to just write off the debt in the books of accounts. That's it. You will get the deduction. Don't worry about it. Okay. So can I get the deduction of bad debts which has been sold by the predecessor? Like the amalgamating company has sold the goods, but the debt has become bad in the hands of the amalgamated company. Will I get the deduction? Yes, the Supreme Court has held that in the case of T. Veerabhadra Rao K. Koteshwara Rao, a very important case law which came in 1985. Even today it is important after 37 years, that the expenditure, the sale which was made by the predecessor, but the debt has become bad in the hands of the successor, it will be allowed as deduction to the successor. Don't worry about it. Next is a very important ICDS. There are certain incomes which are recorded in ICDS but which are not recorded in the books of accounts. So if that be so, if there are certain incomes, like I have said you, that in case of services, it says that you have to record in the ICDS irrespective of whether you expect a reasonable assurance of receiving that money or not. But in accounts, it is very clear, unless you have a reasonable assurance, you are not supposed to record that particular income. So if there are certain incomes, there are a lot of incomes like that. If there are certain incomes which are recorded in tax, you have paid the tax on that, but that is not recorded in the books of accounts. If that income becomes bad later on and you want to claim the deduction, then one of the conditions to claim deduction is you have to write off that in the books of account. So how will I write off that debt which has been subject to bad in books of accounts, which was not recorded only in the books of accounts? Because initially only that income was only recorded in the income tax, it was not recorded in the books of account. So the government says that if there is an income which is recorded in the income tax, you have paid the tax on that, but that is not recorded in the accounts, and if that income which is recorded in the income tax becomes bad later on, then it is deemed to be written off in the books of accounts and you will be allowed the deduction under the income tax law. Don't worry about it. Okay, so you will be allowed because the law has put the deeming fiction over here, and with the help of this deeming fiction you can claim the deduction under the income tax law. Next one, if you are a company, the next deduction, 36 subsection 1 clause 9, is only applicable to companies, not to any other assessee. This is the first deduction under the income tax law so far which is only allowed to company. If a company is incurring some expenses in relation to family planning, promotion amongst the employees, then the company will get the deduction. If the expenditure is revenue, then fully allowed under PGBP. If the expenditure is capital, then allowed in 5 installments in 5 years, 1/5 every year. And there is a loss because of the capital expenditure, not because of revenue expenditure. If there is a loss because of the capital expenditure, it will be treated as good as UAD. It means it can be carried forward and set off for infinite number of years and against any income except the salary income. Next, will I get the deduction of STT? Yes, you will get the deduction of STT. There is no harm in that, provided you should be trader in security, then only. Because in capital gains, if you are an investor, then the deduction of STT is not allowed as per 7th proviso to section 48. In capital gains, deduction of STT is not allowed. But in PGBP, the deduction of STT is allowed under the income tax law. Next, will I get the deduction of CTD, commodity transaction tax? Yes. Again, if you are a trader in commodity, you will get the deduction of commodity transaction tax under the income tax law. Next deduction is only for 36(1)(17) is only for cooperative society who are engaged in manufacturing of sugar and they are claiming the deduction of purchase of sugarcane. So if you are a cooperative society, you are manufacturing sugar and you want to purchase sugarcane, so you should not purchase the sugarcane at a price equal to or more than the price fixed by the government. It means you should purchase the sugarcane at a price equal to or less than the price which is fixed by the government. You should not purchase at more than the price which is fixed by the government. You cannot purchase. If you purchase for more than the price which is fixed by the government, we will not allow you the deduction. And last but not least over here in this chapter, will I get the deduction of mark-to-market loss? Yes, mark-to-market loss deduction will be allowed provided you claim that deduction as per the ICDS. As per the ICDS, if you claim mark to market loss, we will allow with the deduction. If you do not claim the deduction as per mark to market loss as per ICDS, then we will not allow, we will disallow under section 40A13. Sir, what is mark to market loss? A loss which is marked as per market. Suppose if you buy shares of Adani and every day the shares of Adani are facing some losses, so you have to book that loss in your books of accounts as per daily basis. So you will be getting that deduction on a daily basis. So if you record some losses in the books of accounts on a daily basis, then in that case that is called as mark to market loss. So this is what this chapter is all about. Just go through it once and then we'll move ahead with the next part, and that is sector wise deduction. Okay. So now let's go ahead with the next part, that is sector wise deduction, and this is the most important part of your PGBP, and the most important sector is coming, the first sector as the most important one. This is what I say has been asking again and again, that is tea, coffee and rubber. If you are engaged in growing and manufacturing both tea, coffee or rubber in India, then this section is applicable. Now if you only grow, then it is fully exempt because it is agriculture income. If you only manufacture, then it is fully taxable because it is PGBP, business and profession. But if you grow and manufacture, then these provisions are applicable for you one by one. Out of this, these two we have already done, that is explanation 7 to 43.6, and plant, that is section 43 subsection 3. We are interested in the first two now. 33AB, a very unique deduction which says that if you are engaged in growing and manufacturing both tea, coffee or rubber in India, then what am I supposed to do? You have to deposit an amount in NABARD or in any other deposit account. By when? You have to deposit within 6 months from the end of the financial year 22-23. So you can deposit up to 30th September 2023 or before the due date of filing of return, whichever is earlier. Now how much amount I should deposit and how much deduction I will get? Whatever amount you deposit, you have to compare that with 40% of PGBP, and that PGBP should be before two things. Should be before this deduction and it should be before set off of the brought forward losses. So this PGBP has to be before this deduction and before set off of the brought forward losses. Whichever is lower will be allowed as deduction. Now you need to understand that when there is a question which is coming in the exam, what has to be done? First of all, they will be giving you a composite income. This much is the PGBP. Out of that, the first thing which you will reduce is the deduction. How much will be the deduction? The amount deposited or 40% of PGBP, whichever is lower, you will remove that. After removing that, whatever amount will come, do not reduce loss. First, you have to apply what? Apply these rules. What rules? If it is a tea, then do 40-60. If it is a rubber, then do 35-65 business and agriculture. And if it is a coffee, normal coffee, do 25-75. And if there is a coffee which is grown, cured, roasted, lot of business activity, then you have to take 40%, 60%. So you have to apply this rule first before reducing the brought forward losses. So the first step will be your total, your PGBP income plus your agriculture income total. Then you claim deduction from that. Then after that, do not reduce loss. Then first do taxable and exempt income. Once you are done with the taxable and the exempt income, then from the taxable portion you have to reduce the losses. Be very careful. This is what we have done it in class. Okay. Now, this is the first part of this particular section. Now, the second part of this section is, pay absolute attention now. So once I deposit the money in the NABARD, will I be able to withdraw that money? Yes, you can withdraw that money. In some cases it is taxable, in some cases it is exempt. If you withdraw that money on closure of business and on dissolution of firm, then it is taxable. But if you withdraw that money on the death of the assessee, on partition of HUF or on liquidation of company, then it is exempt under the income tax law. So in 2 cases, if you withdraw that money, then it is taxable. In 3 cases, if you withdraw that money, then it is exempt. Be very careful. Now, if I withdraw the money, then what am I supposed to do? Apart from these 5 cases, if I withdraw money in my normal business, my business is a going concern, it is going on. And if I withdraw the money in normal cases, so if you withdraw the money in normal cases, then you have to use that money for specified purpose in the same financial year. That is, if you withdraw the money in 24-25, then you have to use that money for the specified purpose in 24-25 only. Otherwise, it will become deemed income. Sir, how much will be the deemed income? Deemed income will be only to the extent of 40%, 25% and 35%. That is to the extent of taxable portion. Taxable portion from this chart. The deemed income will be only to the extent of taxable portion from this chart. Okay. Sir, if I withdraw the money in 24-25 and if I incur some expenditure of salary, will I get the deduction of salary also? No. That will lead to dual deduction. So if you withdraw the money and if you incur some expenses in the form of say salary, you have paid some gratuity, then you cannot claim the deduction of that gratuity and that salary again, because already the amount which you are withdrawing, that is claimed as deduction over here under PGBP in financial year 22-23. So once you withdraw and use it for specified purpose, the deduction of actual expenditure will not be allowed to you. Sir, can I withdraw the money and purchase some assets? Yes, you can purchase some assets, but some prohibited assets which the government has told you should not purchase those assets. Sir, which are the prohibited assets which the government has prohibited for us to buy? You should not buy a plant and machinery which is used in office. You should not buy a plant and machinery which is used in residential accommodation. You should not buy a plant and machinery which is in office appliance, but you should buy computer. You can buy computer, it's all fine. You can buy land, you can buy building, all these things you can buy. You cannot buy these 3-4 items which I mentioned over here, but you can buy computer, that is allowed. Sir, once I buy the asset, is there any lock-in period for the asset? Yes, the government has said that there is a lock-in of 8 years for that particular asset which you are buying. 8 years from the end of the financial year in which the asset is bought. And if you sell within 8 years, then the amount which was allowed as deduction will be considered as deemed income. At the same time, you will also be chargeable with capital gains because you are selling some capital assets within 8 years. So in that case, you will also be liable for capital gains. But there are some exceptions in which if you sell, then it is allowed. If it is sold to government or it is sold to local authority, then there is no deemed income. And if it is sold in the case of succession of a firm to company, then also it is not considered as a deemed income. Now, there is a similar section like this, that is 33AB, which is known as Site Restoration Fund, and which is for prospecting, extraction or production of mineral oil, petroleum, natural gas in India. Now, this section is exactly similar to the previous one with some changes. There we deposit in NABARD, here we deposit in SBI, there we deposit within 6 months from the end of the financial year, here we have to deposit before the end of the financial year. There the deduction was maximum 40% of PGBP, here the deduction is maximum 20% of PGBP. Rest all provisions are exactly copy paste like the previous section, so you don't have to waste much time in reading them again. Now coming to the next one, and a big one, that is expenditure in relation to scientific research deduction. In all, there are 7 sections over here which you have to understand one by one. Let's target the first two, 3511, 3514. If you are engaged in the business of scientific research, your business is scientific research like your Cipla, your Tata Motors, your Infosys. So in your business, there is a scientific research. So if you are engaged in scientific research, you will get the deduction of these two sections. Now, what is the difference between these two sections? Let me tell you the difference. 3511 is for revenue expenditure and 3514 is for capital expenditure. So in this case, in both the sections, you will get deduction of pre-commencement also. Of how many years? Of last 3 years. So pre-commencement expenditure which is incurred before the business has commenced, that also will be allowed to you. So in revenue expenditure, which all pre-commencement will be allowed, salary will be allowed, purchase of raw material will be allowed, but it should be approved by Director General of Income Tax. In pre-commencement of capital expenditure, which all expenditure will be allowed, all building, plant, machinery, furniture, everything will be allowed except land. Land will not be allowed as deduction to you as a pre-commencement expenditure. Apart from land, all other expenditure will be allowed to you. That to how much? That to 100% of the pre-commencement expenditure. Revenue expenditure will also be allowed 100%. Capital expenditure, that is a very great benefit given by the government of India. That is even capital expenditure like plant, machinery, furniture, building is allowed to the extent of how much? 100% deduction to the assessee. What about in the post-commencement? Even in post-commencement, you will be given the deduction of revenue expenditure, all revenue expenditure, and even in post-commencement of capital expenditure, all capital expenditure except land. Land will not be allowed as deduction, neither in post nor in pre. Sir, pre-commencement, all deductions of last 3 years will be allowed when? It will be allowed in the year of commencement of the business. Sir, what about the expenditure which is incurred beyond 3 years? Just forget that, you will not be getting the deduction of those expenditure. Sir, will I get depreciation on plant, machinery, furniture, building after claiming this deduction? Please don't ask for a normal depreciation. Please don't ask for the additional depreciation also. Once you claim deduction under this section 3511, 3514, you are not going to get any kind of depreciation deduction once again. Please, we are really sorry for that. Okay. Next. 352AB. How this is different from the previous two section? This is different to a great extent. First of all, this deduction is only available to company. It is not available to other than company. Like the previous section which we have done, I have done an interlinking over here. Like the family planning expenditure was allowed only to company and not to other assessees. Secondly, this deduction is only allowed to assessees engaged in manufacture of any article or thing other than 11 scheduled products. There are certain 29 products which are mentioned in 11 schedule. You are not supposed to remember that. It is not mentioned in your study material also. Apart from those 29 items, you can manufacture any article or thing, or you can also be engaged in the business of biotechnology. Thirdly, you should do in-house research. Your research should be approved by prescribed authority. You should have an agreement with central government. Fourthly, you will not be given the deduction of land and building under this section. Land is not allowed only anywhere, but you will be getting the deduction of building under the previous section if you wish to claim that. But in this section, land and building both are not allowed. Last but not least, you will get the deduction of only post-commencement over here in 352AB. You don't get the deduction of pre-commencement in 352AB. And apart from this, all other revenue and capital expenditure will be subject to what? 100% deduction under the income tax law. So this is your third section. As I've told you, there are in all 7 sections over here. Now coming to the second part of this particular section, and that is now you are giving contribution to certain outsiders. That is, if you don't want to do research, then you can contribute to others for research. So now here there are 4 sections, 3512. If you make contribution to certain research association, college, university or institutions who are engaged in scientific research, you will get as a donor 100% deduction subject to some condition which I am telling now. Second, if you make a contribution for scientific research, apart from scientific research, if you are making a contribution for statistical research or social science, then also you will get 100% deduction. Third, 352AA, if you make contribution to what? National Laboratory or Indian Institute of Technology, any Indian Institute of Technology across India, there are so many IITs across the country. If you make contribution to any IIT, you will get deduction under the income tax law. And the fourth one is, if you make contribution to Indian companies who are engaged in scientific research, these were not Indian companies, these were certain associations, college, university, but this is an Indian company. If you make a contribution to Indian company, then also you will be getting the deduction of what? 100% over here. All these institutions which are mentioned above have to be approved by the certain prescribed authority by the government. Now there is one point over here. Suppose if I make a contribution to a institution or a college and I took the deduction, and later on if the approval of that institution is withdrawn by the government, will I be eligible to claim the deduction under section 35 2AA or 12 or 13? The answer is yes. Check over here. Merely because the approval is withdrawn of the institution, that will not deny your deduction. You will continue to get the deduction. Don't worry about it. Is it clear to all of you? Now, there are some very important amendments which are made by the government in the last 2-3 years. Let me tell you that important amendments, all of them are interlinked to each other. The first thing is the donor, I am donor, you are donee. The government has put 2 responsibilities on donee. First is the donee has to file a statement with government that who all have given him donation. That is the first thing that the donee has to do. Second thing, the donee has to give donor a certificate. Otherwise, the donation is not valid. So, donee has to do 2 work. First of all, file a statement with central government, with the government authority that who all have given the donation. Second, give donation certificate to the donor. If the donee does not do these 2 things, then the donee will be liable for a fee of 200 rupees per day for every day during which he continues to do this. So, if there is a failure to do this, then the donee will be liable to face what? A fee of 200 rupees per day. Apart from that, if he does not furnish this statement, or if he does not give the certificate to the donor, then the donee may liable for a penalty of 10,000 rupees to 1 lakh rupees, which will be imposed by the AO. So if the donee does not do these 2 things, then the donee has to face the fee. The donee has to face the penalty of 10,000 to 1 lakh rupees. Now the government has made one more amendment over here, and now the government is making the donor also face the consequence, that if the donee does not do these 2 things, then even the donor will not get the deduction under the head PGBP. Till last year, only donee was facing the penalties and fees. But now Finance Act 2022 has said that even the donor will not be eligible to claim deduction under these sections if the donee does not fulfill these 2 commitments. So be very careful. This is a very important point. Now coming to one last part in this particular section. Suppose if you have bought a plant and machinery of 100 crore and you have claimed deduction of 100 crore under section 35(1)(4). Under section 35(1)(4), you have claimed a deduction of 100 crore as a capital expenditure. You have bought a plant and machinery. Now after some years, if you decide to sell that, now there are 2 possibilities to sell that. Either you can sell that without using for any other business or profession. So you are selling that from the research department only. Then what will happen? The government says that then there will be deemed income. How much deemed income? Whatever is the sale price compared with the deduction allowed 100 crore, whichever is lower, that will be deemed income. And you also have to pay capital gains because you are selling a capital asset. So you may also be liable for paying what? Capital gains under the income tax law. So this is for assets which are sold without using for business. Now for example, after 3-4 years, I transfer this asset for my business. So in that case, what will happen? So if I transfer this asset, I am not selling that directly. I am transferring that in my business and then I am using it for my business, and then I am transferring, then I am selling that later on after some years. So if I transfer this asset to my business, then this plant and machinery has to be forming part of my block of my business, whichever business it is. So in that case, the question is, what will be the actual cost of that machinery? The actual cost of that machinery is defined in explanation 1 to 43(1), which says that the actual cost of such machinery shall be taken as nil. You can go back to the chapter of depreciation and see that was the first explanation over there. And now this machinery will form part of block. Why nil, sir? Because you have claimed 100% deduction on this machinery. We would not like to again give you what? Depreciation on the same machinery which is already claimed as a PGBP expense. Therefore, it will be added to the block of machinery. The quantity will be added to the block of machinery, but the amount will be added in the form of 0 rupees. And then whenever you will sell this machinery, you will be subject to what? Capital gains under section 50, that is short-term capital gain. This is what this provision is all about, and this is what scientific research section is all about. Just go through it once and then we'll move on with the next part. So now let's move on to the next one, that is a small section, amortization of telecom license fees and spectrum fee paid, which is covered under section 35A(bb) and 35A(ba). So if you pay any telecom license fee or a spectrum fee, first of all, the deduction is allowed on payment basis, not on accrual basis. Accrual deduction is not allowed here. Secondly, if you make the payment before the commencement of the business, then the deduction will be allowed from the year of commencement. And from the year of commencement, it will be allowed over the unexpired life of the year of the license. Okay. So if you make the payment of say 10,000 crore before the commencement of the business, then it will be allowed from the first year of the commencement over the life of the license. And if you have made the payment of the license after the commencement of business, then it will be allowed from the year of the payment itself. And that too, if you are making payment in installments, then it will be allowed in the following manner. For example, the license cost is 10,000 crore and the life is 10 years, for example. And if you are making payment of 5,000 crore today, then you will be getting the deduction of 5,000 crore divided by 10 for 10 years. And 3,000 crore you are paying in the second year. So from second year onwards, you will get how much extra? 3,000 crore divided by 9 years for 9 years. Then from in third year you paid the remaining 2,000 crore. So in the third year onwards, you will get what extra? 2000 crore divided by 8 for the remaining 8 years. Okay, so this is how the deduction will be allowed for this particular section. Once you claim deduction under this section, you will not get any deduction under section 32 in the form of intangible asset. Please spare us. We are not going to give you any deduction in the form of intangible assets under section 32. Okay. Next, later on, if you sell that license, then obviously you have to bear some deemed income along with the implication of capital gains, which can come on you because you are selling a capital asset. So you might be liable for what? Capital gains in chargeability, short term or long term, as the case may be. Okay. Let's move on to the next sector wise deduction, that is section 35D. What does this section talks about? This section talks about preliminary expenses. And first of all, let us identify this section is available to whom. This section is available to, first of all, Indian company. And if you are not company, then you have to be resident. So either Indian company or other than company, you have to be resident. First thing is that. Second thing is you have to incur the expenditure on certain specified purpose. And when should the expenditure be incurred? Be very careful. You should incur the expenditure either in pre-commencement, but if you are incurring the expenditure in post-commencement, then there are some conditions. Then you have to incur the expenditure either for extension of the business or for setting up of a new unit. Then only the deduction will be allowed. So in post-commencement, the government is putting a condition of extension or setting up. Otherwise, you are not going to get the deduction. The third question, how much deduction will be allowed to you? Now, this is the most important question. So here you have to compare two items. First is find out the actual expenditure. Found out, sir. The actual preliminary expenses which you have incurred, you have to identify that. Sir, done, sir. Now compare that with two items. 5% of the cost of project. Sir, cost of project means the cost of all the fixed assets you have bought. Compare that with 5% of the capital employed. Sir, capital employed means three items: share capital, long-term borrowings and debenture. Sir, does capital employed will include share premium also? No. The Supreme Court in the case of Berger Paint Limited has held that capital employed shall not include share premium. It shall only include the paid up share capital, nothing else. So you have to take 5% of the cost of project, compare that with 5% of the capital employed, and then whichever is higher will become your point number 1. And then you have to compare point number 1 with point number 2, and then whichever is lower will be considered as your actual deduction. And in that also there is a catch. You are not going to get the deduction in one shot. You will be getting this deduction over the life of 5 years. So you'll be getting this deduction over 5 installments. So what is the first step? First step is to find out the actual expenditure. What is the second step? 5% of cost of project, 5% of capital employed, whichever is higher, take the higher of that, and then compare that with actual. Whichever is lower will be allowed as deduction. Over how many years? Over 5 years. Now, the question is, this 5% of cost of project and 5% of capital employed has to be taken on which date? It has to be taken on the last day of the financial year in which the business is commenced, or last day of the financial year in which you are extending or setting up a new unit. So it has to be computed on the last day of the financial year in which the business is commenced, or last day of the financial year in which the business is commenced or business is extended, as the case may be. Now, last but not least, suppose this deduction is not available to company. Then what to do? If this deduction is available to individual or HUF, they have to be resident first of all. As I have told you, they need to be resident. Secondly, if it is not available to a company, then you have to ignore this point. Because if there is no company, the question of capital employed does not arise. Then you have to directly compare the first 5% of cost of project with your actual expenditure, and whichever is lower will be allowed as deduction. And that is what it is written over here. You can check it over here. Is it clear? I hope it is clear to all of you, right? Let's move on to the next one. That is the big one. Investment linked deduction under section 35AD. First of all, this deduction is only available in respect of a capital expenditure. Revenue expenditure is not allowed as a deduction under this section. This is the first thing you need to understand as a student. Second thing, there are in all 14 businesses in this section, out of which 2 businesses are only available to Indian companies or consortium of Indian company. Consortium means joint venture of Indian companies. So let's see the 14 business first of all. First is cold chain facility. You should be engaged in cold chain facility of certain products. You should be engaged in warehousing of agricultural products. You should be engaged in hospital of at least 100 bed or more than 100. You should be engaged in housing project of affordable housing scheme, or you should be engaged in housing project of slum redevelopment. You can be either of the two, affordable housing scheme or slum redevelopment. You should be engaged in production of fertilizers. Okay. You should be engaged in cross country natural gas pipeline or crude or petroleum oil pipeline, cross country, not within the country. You should be engaged in hotel of at least 2-star or above category. 2-star of above category. 2, 3, 4, 5, 6, 7, everything will be fine. 1 star will not be fine. You should be engaged in the business of inland container depot, container freight station, which is conducted at the ports across the country. You should be engaged in beekeeping, production of honey, production of beeswax, wax candles, which is made of what? Warehousing for sugar facility. Warehousing for sugar, you should be engaged in this. You should be engaged in laying and operating a slurry pipeline for transportation of iron ore. You should be engaged in the business of manufacturing of semiconductor wafer fabrication unit. Or you should be engaged in any infrastructure facility in India. An infrastructure facility will include what? It will include road, it will include highway project, it will include housing project, it will include water supply projects, sanitation project, irrigation system, water treatment system. It shall include ports, airports, it should include inland waterway, navigational channel. All these things will be considered to be part of what? Infrastructure facility. Now there is one case law over here. The second one, first one is not that important. That is a very well established part of the law now, so that is not much relevant. The second one is important. Seabros Hotels Private Limited. Suppose in financial year 22-23, the company has made an application that please give me a category of 2-star or 3-star or 4-star, because the starring category is given by the central government. So if I am making an application to the central government for starring category, and the central government is giving me the starring category, giving the approval in next year, then will the deduction be allowed in the current year, or will the deduction be allowed in the next year? So the court has said that in this case the deduction will be allowed from the year in which you have made an application, and not from the year in which you have got the approval. So if you have made the application in the current year, you will get the deduction from current year and not from next year. Okay, next, the 6th and the 14th business will be applicable only to Indian companies, not to every SSE. Rest of the 12 businesses can be claimed by any of the SSE, but the 6th business, that is cross-country natural gas oil pipeline, and the 14th business, that is infrastructure facility business. These are two very big business. These are only available to Indian companies or consortium of Indian companies. These are not available to other SSE. Coming to the deduction, how much deduction will be available? 100% deduction. When deduction will be available? Will I get the deduction of pre-commencement of business? Yes, but only condition you have to fulfill, you have to capitalize the entire expenditure in the books of accounts on the date of commencement of the business. Whichever day you will commence the business, you have to capitalize the entire expenditure. You will get all the capital expenditure which you have incurred in pre-commencement. Post-commencement also, whatever expenditure you will incur, you will get it. But there are 3 capital expenditure which the government has denied. They have said that we are not going to give you these 3 deduction. One is land, one is goodwill, one is financial instrument. These 3 deductions you are not going to get even in pre nor in the post. In neither of the time you are going to get these 3 deduction. And the next one, if you are making a payment of more than 10,000 rupees for acquiring an asset to any person in a day, then you have to make the payment by account pay check, account pay draft, ECS or such other electronic mode. Otherwise, we are not going to give you what? The deduction under the income tax law. Next, there are further more conditions that you have to fulfill being an SSE. First, your business has to be absolutely new. Your business should not be formed by reconstructing or splitting up of an already existing business. I used to give an example in the class. First Ajay Limited, then Budget came, then Vijay Limited. You cannot do that. First Ajay Limited, then Budget came that you will get this deduction. So you closed the old company and converted that into a new company. Not allowed as deduction. You should not install second-hand plant and machinery in your business. Second-hand plant and machinery will not be allowed. But there are 2 relaxations given by the government. First, second-hand plant and machinery up to 20% of the total value will be allowed, and second-hand plant and machinery of what? Of imported nature will be allowed, provided no depreciation should be claimed on that earlier. If there is no depreciation claim on that earlier, then you can import a second-hand plant and machinery and claim deduction under 35AD. Okay, once you claim deduction under 35AD, no deduction under chapter 6A, no profit link deduction will be allowed, no 10AA will be allowed, no normal depreciation, no additional depreciation, nothing will be allowed to you under the income tax law. Next, there is a special benefit given to the hotel industry. Now, for hotel industry, what is written in the law, you know, the hotel has to build the hotel and operate the hotel. Both the things have to be done by the hotel. But the hotel business runs on a franchise model, whereby the hotel will build the hotel, but operations will be transferred to somebody else to be doing that. In that case, the government has said that, the government has given a relaxation and said that if the hotel builds and transfers the operation to someone else, but continue to own the hotel by itself, ownership is in the hands of the SSE, but the operations are given to somebody else in the form of franchise, then the deduction will be allowed to the SSE. Don't worry about it. Next, what if the SSE incurs losses? Because the SSE is going to get so much deductions over here that there are bound to be losses over here in the first few years. So what will be happening with the losses? So for that, the government has made a special section. The first benefit the government has given over here is you can carry forward and set off that loss for infinite number of years. There is no time limit in carrying forward and set off. Secondly, there is a restriction over here, but you can set off only against the specified business. You cannot set off against your other business. It means you have to set off this loss only against these 14 businesses. You cannot set off against any other business. Next, some deemed income concept is also there. Suppose if you have bought some building of 100 crore rupees, and you have claimed a deduction of that 100%. Now later on, if that building is demolished and you receive some money, and if that building is destroyed and you receive some money in the form of insurance claim, or if you have discarded that asset you receive some money, or if you have sold that deliberately, that asset, and if you receive some money, then it will be deemed income under section 28. No time limit. After 1 year, after 2 years, after 5 years, after 10 years, after 15 years, after 50 years, if an asset on which the deduction is claimed under 35 AD, if it is sold, if it is discarded, if it is demolished, if it is destroyed, then the amount received in the form of a sale price will be deemed income, will be deemed income, will be deemed income. Now there is one more deemed income which says that if you buy an asset, then you should use that asset for specified business for a period of 8 years. You can check over here. If it is not used for a period of 8 years, then there will be another deemed income which is given under subsection 7A and subsection 7B. And what will be the deemed income? In that case, the government says that whatever is the deduction allowed will be considered over here, and then for how many years you have used it for business purpose, for specified business, that much depreciation you have to use it, that much depreciation you have to reduce it. Suppose I bought this asset in the current year for 100 crores. I claim that particular asset as a deduction under 35 AD. Now after 2 years, I am transferring that asset for some other business. Then I am violating this provision. For 8 years, you are supposed to use it for the purpose of business and profession mentioned under 35 AD. Now after 2 years, if I am doing this, then the government says that you have to reduce 2 years depreciation from here. That is 2 years depreciation will be on building will be first year 10 crore, second year 9 crore, because on WDV 9 crore, and then 81 crore will be your deemed income. You have to pay tax on that. If you are a manufacturing assessee and if you are buying plant and machinery, then you also have to consider what? The additional depreciations effect over here. According to the case, you have to reduce the depreciation from here. Once you reduce this depreciation, whatever income is there, you have to pay tax on that. And now this asset has free now. Now you can use this asset for any purpose because you have borne the burden of deemed income on that asset. So now later on, if you use this asset for any other purpose, then you can claim depreciation on 81 crore. As you can see over here, this 81 crore will become actual cost of your asset for your any other business. You can use that asset for any other purpose. Okay, let's move on to the next section, 35E. Again, this deduction is only available to residents and Indian companies, just like 35D. 35E is exactly similar to 35D as far as the nature of assessee is considered. Indian company or residents. Okay, now what am I supposed to do over here? I am going to prospect some mineral oils over here, some development on mine. I am going to incur some expenses over here. Now this is slightly tricky particular provision, not that very simple to understand. Suppose today is financial year 22-23. Okay, so let's take an example and understand this provision. So if whatever expenditure I have incurred in the current year and in the last 4 years, that will be considered as a qualified expenditure for me. You can see expenditure incurred during the current year of commercial production and the last 4 years will be considered as a qualifying expenditure. Now out of that qualifying expenditure, if any expenditure is made by any government, suppose total expenditure incurred in the current year, that is in the year in which I am exploring the mine, and the last 4 years in which I was just trying to find out whether something minerals is being found out of that mine or not. So expenditure incurred in the current year and in the last 4 years, you have to sum it up. Oh, done? Yes, done. Total 10 lakhs. So out of that, see if government has met any portion. Suppose 50,000 is met by government. Reduce that. 9,50,000. Now this 9,50,000 will be allowed to you over the life of 10 years. So it will be allowed to you over 10 years. So this 9,50,000 will be allowed to you over 10 years as 95,000, 95,000, 95,000, 95,000, 95,000 for 10 years. Now the last question is, this should be set up against which income? This should be set up against your new income, new mine income, as well as your old mine income. If you have any income from the old mines which you have been digging out since last 20-30 years, you can set off this 95,000 against this income also, against old mine income also. Suppose this mine's income is 30,000 and old mine income is also 30,000, so you can set off this 95,000 against the 60,000 rupees, and the balance 35,000 you can carry forward and set off in the next year against next year's mining income. So you are allowed to do that up to which year? Up to 10th year. Okay, now this expenditure which is covered over here does not include capital expenditure. Like if you incur some expenditure on acquisition of site, if you incur some expenditure on deposit acquisition, if you incur some expenditure on acquiring what? Building, plant, machinery, furniture, then that is not allowed over here. You can claim depreciation under section 32 subject to the conditions which are mentioned in section 32. You can claim depreciation over there. Next, let's move on to a very important section, that is provision for bad debts, which is given under section 36(1)(7)(a). As we all know that 36(1)(7) only allows deduction of actual bad debts. It does not allow deduction of what? Provision for bad debts. But provision for bad debts will be allowed to you over here based on some standard percentage. If you are a scheduled bank, or if you are a non-scheduled bank or a cooperative bank, then the percentage is different. And if you are a public financial institution, state financial institution, or foreign bank or NBFCs, then the percentage is slightly lesser, the benefit is slightly lesser. So for scheduled bank and others, there are two benefits. 8.5% of the gross total income and 10% of the aggregate average advances made by only the rural branches, not the urban branches. So 8.5% of the GTI plus 10% of the rural branches advances, both the benefits will be given to you as deduction. And for others, it is only the first one, second one is not available. That also on a lower side. That is only 5% of the total income will be allowed as deduction to them. That is which total income? Total income or gross total income? Gross total income, because it is written before giving this deduction and before chapter 6A. So which total income comes before chapter 6A? It is always the gross total income which comes before chapter 6A. Now, if I claim this, will I get the deduction of actual bad debts also? Now listen carefully. If your actual bad debts exceeds the provision for bad debts, then it will be allowed. For example, if your provision for bad debts is 100 rupees and your actual bad debts is 150, then you will get 50 rupees deduction under actual bad debts. But if your provision for bad debts are 100 and your actual bad debts are 40, then you are not going to get the deduction of actual bad debts. And when you compare the actual bad debts with provision for bad debts, you have to compare your actual bad debts of current year with the accumulated provision for bad debts. Means if there is some opening provision for bad debts, that also should be considered, and if there is some current year of provision for bad debts, that also should be summed up, and then both of them should be compared with what? Your current year actual bad debts. And if your actual bad debts exceeds both of them, then it will be allowed as deduction under 3617. Otherwise, you are not going to get any deduction under section 3617. The next deduction is a transfer to reserve deduction, which is given under section 36 subsection 1 clause 8. What am I supposed to do? You are supposed to just transfer your profits to a particular reserve, that is known as special reserve under 3618. This is available to whom? This is available to certain banks, certain public financial institutions who are engaged in providing long-term finance of at least 5 years for agriculture purpose, for housing purpose, for infrastructure purpose, or for the purpose of industrial purpose. So if the banks or certain financial institutions are providing long-term finance for these 4 purposes, then they will get deduction of the lower of the 3. What is the lower of the 3? First is the actual amount transferred to the reserve account, point number 1. Second is 20% of the profits from this business only, not all business, not the entire PGBP. 20% of the profits which they generate out of this business of lending to the financial, lending to these 4 people. And then third one is 200% of, be very careful, paid up capital and general reserve on the last day of the financial year. You have to take the last day financial year paid up capital and general reserve, do 200%, that is multiplied by 2, and then you have to reduce from that opening balance of special reserve account as on the first day. Then whichever is lower out of the 3, you have to claim that as a deduction under section 3618. Once you transfer that amount to the special reserve account, if you withdraw that amount again and again credit that to P&L, then it will be deemed income under section 411A. You can check it over here. Is it clear? That will be deemed income under 411A. You cannot withdraw that amount from the special reserve account and credit it to P&L. If you do that, it will be deemed income under 411A. Next, there are few small miscellaneous deductions which are given over here. Let me talk about them one by one. These are one-liner deduction. First one is 35 CCA. If you make a payment for rural development to any association or institution, it's a kind of donation. So if you are doing some good deeds in your life by giving donation to certain rural development association or rural development institution, you will get the deduction. Okay. Second one is amalgamation and demerger expenses. Now this deduction is only available to Indian companies, not to every kind of assessee. That too, this deduction is available in 5 equal installments. It will not be available in one shot, but it will be available over the life of 5 years. Third, amalgamation, after amalgamation, VRS expenses. This will also be allowed not in one shot. This will also be allowed in 5 equal installments. That is over the 5 years you will be getting this deduction. Next, if you incur some expenses for agriculture purpose, if you incur some expenses for promotion of agriculture extension projects, agriculture related projects, if you incur some expenses, you'll be getting the deduction under 35 CCC. And if you incur some expenses on skill development of employees, you will get deduction under section 35 CCD. But there are 2 points to be kept over mind. This deduction is only available to companies, and this deduction is not available if you incur the expenditure in the form of land and building. Apart from land and building, you will get all deduction if you are a company. This deduction is only available to company and nobody else. And one last deduction, which is absolutely not important, section 42, which says that if any company enters into an agreement, any oil exploration company, oil prospecting company like ONGC, etc., if they enter into an agreement with central government for what? Exploration of oil, for commercial production of oil, for drilling of oil, for exploration and for depletion of mineral oil, etc., all these related expenses, then the expenditure will be allowed as deduction as per the agreement with the central government. Therefore, this particular section is not relevant for exam, because here if an oil manufacturing company or oil exploration company or oil prospecting company like ONGC enters into an agreement with central government, then their deduction will be decided as per the agreement with central government, and it will not be decided as per the income tax law. Okay, so here we complete what? All the sector wise deduction. Just go through all of them once, and then we'll move on to what? The deduction of general deduction. Okay. So let's go ahead with the next section and the last deduction which is there in the chapter of PGBP, that is General Deduction 37.1. Now before we start the discussion of 37.1, we need to understand that what is the treatment of losses under the income tax law? Are losses allowed as deduction under the income tax law? So for that, the Supreme Court has held long back in 1959 that yes, the trading losses will be allowed as deduction. If the losses are trading in nature, which are incidental to day-to-day business, it will be allowed as deduction. If the losses are capital in nature, then it will not be allowed as deduction. This is the first thing that you have to keep it in your mind when you start with this particular topic. Second thing, general deduction has 4 conditions. You have to fulfill the 4 conditions. There are 3 negative conditions and there is 1 positive condition. Now, what are the 3 negative conditions? Your expenditure should not be mentioned in 30 to 36. Your expenditure should not be personal, it should not be capital, and it should be incurred wholly and exclusively for the purpose of business and profession. So, there are 3 negative conditions, not, and 1 positive condition. Okay. Now, there are a lot of explanations which are attached below this section. The first explanation says that if you incur an expenditure for an offense which is prohibited by law, or which is for an offense or which for any activity which is prohibited by law, then that expenditure will be disallowed. Like if you give some hafta, some bribe, some secret commission to someone, then it shall not be allowed to you because that is an illegal expense. But there was no clarity regarding few things. First thing, when the law says that you should not incur an expenditure for an offense or or which is prohibited by any law, which law? Indian law, foreign law, or both the laws. So Finance Act 2022 has made that clarification in point number A over here, which says that you should not break an Indian law, even a law which is outside India, you should not break that law also. The second clarification has come for the pharma companies. What happens? The pharma companies gives freebies to the doctors and the medical associations, medical institutions. So this acceptance of freebie from the pharma company and from the pharma company by the doctors and by hospital is bad in law. It is against the Indian Medical Council Act 1956. So if a pharma company gives that particular thing to doctor which is not accepted by that doctor should not accept that. Giving that is also an offense. So Government of Finance Act 2022 has made a clarification that if you give any freebie to what? To a doctor or to a medical association, that freebie will also be what? Disallowed under the income tax law. This is the reason point number 2 has come. Third point has come for what? Again, these are all clarifications. These were applicable earlier also, but the law was not having proper clarity. So the Finance Act 2022 has given a proper clarity regarding these issues. The third one, if you compound an offense, compounding an offense means what? You were supposed to be prosecuted, but you are making a heavy payment of a fee so that you should not be prosecuted and put in jail. For that, you pay a compounding fee. So what is the treatment of that compounding fee? Will I get the deduction of that compounding fee also? The government has again said that no, the compounding fee will also not be allowed, whether you are compounding any offense under Indian law or a law outside India. Irrespective of that, you will not be allowed the deduction of what? The compounding fee. Next, what explanation 2 says that? Explanation 2 says that if you incur any expenditure in the form of a corporate social responsibility, you will not be allowed the deduction under section 37(1). But you have to be very careful that if the corporate social responsibility in expenditure which you are incurring, if that is allowed as deduction in some other section like PM Care Fund, that is allowed as deduction under ATG, like Clean Ganga Fund, that is allowed as a deduction under ATG, Swachh Bharat Abhiyan Fund, that is allowed as a deduction under ATG, or Payment for Scientific Research Association or Statistical Research Association, that is allowed as deduction under section 35. That will not be disallowed. That will be continue to be allowed in those respective section. Which CSR will be disallowed? Only those CSRs will be disallowed which you are coming under 37(1) and claiming the deduction as. So moral of the story, if a CSR expenditure is specifically allowed under some other sections of income tax law, it is allowed. If it is not allowed in other section and you are coming under 37(1) to claim deduction under 37(1), then it will not be allowed to you under the income tax law. So what is the treatment of penalty? Now penalties can be of 2 nature. One is compensatory, one is penal. If it is a penal penalty which is for breaking a law, then it is not allowed. But if it is a compensatory penalty, which is for like a compensation, for example, I have not completed your batch and delaying the batch, so I am making some payment to you as a compensation, that is a compensatory penalty, that is allowed under the income tax law. Okay. What about income tax penalty and interest? Whatever charges you pay under income tax law, whether it is interest or penalty, not allowed, not allowed, not allowed. What about penalty of GST? Penalty of GST also not allowed because it is for breaking a GST law. What about interest of GST? Interest of GST will be allowed to you under the income tax law. Interest on GST will be allowed. Penalty under both the laws will be disallowed. And in income tax law, everything will be disallowed. Whether it is interest or penalty, it doesn't matter. Okay. What about secret commission? If you give some secret commission to someone, sir, what is secret commission? It's a commission which is under the table to acquire certain contract. If you want to take certain contract in your control, you have to pay this commission. That is known as secret commission. Not allowed, not allowed, not allowed. Okay. Next, this CBDT circular which was there earlier. So Finance Act 2022 has put a what? Full stop on this circular by saying that this circular is correct. What does this circular say? This circular says that any freebie which is given by pharma company to doctors and hospitals shall be disallowed under explanation 1 to 37.1. This is what the Finance Act 2022 has made an amendment over here, and specifically this particular point has been put as a part of the law. So now nobody can raise a question because circular says something which everybody can challenge, but the law cannot be challenged. Okay. Second, next, what about the keyman insurance policy? If I am a firm and I am paying a keyman insurance policy for my partners, will I be allowed as deduction? The answer is yes. If a partnership firm makes a payment of keyman insurance policy premium, will be allowed if that partner is very important to the firm. This not having that partner will disrupt the business. If that partner is important and if the firm is paying keyman insurance policy for that partner, it will be allowed as deduction under 37.1. Next, what about losses of illegal business? The Supreme Court in the landmark judgment of Dr. T.A. Qureshi has held that if you incur an illegal loss, then that shall be allowed as deduction. That cannot be disallowed in 37.1 because 37.1 only talks about losses of expenditure of illegal nature. It does not talk about losses of illegal nature. Therefore, the 37.1 cannot cover such cases. If there is a loss of illegal nature, that should be allowed to you on the basis of what? Commercial accounting principle. Next, what about advertisement in a brochure of a political party? If I do advertisement in a brochure of a political party, that is not allowed under section 37(2)(b). Next, clarification on BOT project. What is BOT first of all? Build, operate, transfer project. What happens in that? Suppose I am an assessee and there is a government. Government will give me a land and will tell me to make roads, will tell me to make highways, and will tell me that you have to make roads, you have to build, then second, you have to operate that for 15-20 years, enjoy the toll out of it, and then after 15-20 years, you have to transfer back the road to the government of India. So the government will give me roads, will give me land, I'll make roads, I'll build roads, I'll operate roads, and I will then transfer back to the government. That is the BOT project. So the question is, whatever expenditure I've earned in this BOT project to make the roads, how will I get the deduction? The government has said it very clearly. You will get the deduction over the life of the project. That's what it is said. It means if the project is given to you for you to operate for 20 years, it will be allowed over the life of 20 years. Okay, this is what this clarification has to say. Now there are a lot of small case laws which I have to address one by one. The first case law talks about Kerala road lines, which says that there was an assessee who has bought a building. Listen carefully. Then he demolished the building. Whatever scrap came out of that building, he gave that scrap as he offered that scrap as a PGBP income. At the same time, he also has to make the payment for the building. So he delayed in making the payment. So when he delayed the making in payment, he has to pay the interest to the other person. So whatever PGBP income came from scrap, against that income, he set off what? The interest income for delayed payment of building. Will that be allowed? The Supreme Court held that yes, because the interest is related to building and the building is sold and the scrap is related to building. Interest is also related to building. Both of them can be set off and it can be allowed as deduction. The next case law is very simple, which I have been repeatedly telling you 2 times already. I have said you the Supreme Court, the Himachal Pradesh High Court has held that the pharma company, whatever freebie they give to what? Doctors, medical association shall not be allowed. Similarly, the diagnostic centers, laboratory, pathological labs, whatever commission they give to doctors so that doctors can refer their name for the purpose of what testing and all, that is also bad in law. That is also not allowed under the income tax law. Is it clear? Next one, Motijal Khemchand Tobacco Product Private Limited. What has happened in this case? In this case, the director of the company was on a business visit in a jungle, in a forest, and in the forest he got kidnapped and police was unsuccessful to get him released. So in that case, the company paid the ransom to the dacoits. So that ransom which is paid to the dacoits, because the police was unsuccessful, the Madhya Pradesh High Court held that it shall be allowed as deduction. It shall be allowed as deduction. Just check it. Next one is Shanti Bhushan versus CIT. First of all, unfortunately, Shanti Bhushan is no more with us. Last week only he got expired. He got dead. And that was a very sad news for the entire country. Who is Shanti Bhushan? I have told you about him in classroom also. He's a very great lawyer of our country. So coming back to the discussion, Shanti Bhushan has done his heart surgery. So the government has said that expenditure incurred on heart surgery will not be allowed as deduction. It's a personal expenses and therefore it shall not be allowed as deduction at all. Okay. Next one, Millennia Developers Private Limited. What has happened in this case? The assessee was supposed to make a building of 7 floors, but assessee made a building of 8 floors. So one extra floor, he is breaking a municipal law, and for that he is making a payment of compounding fee. Whether that compounding fee will be allowed as deduction, and the answer is no. The High Court has said that it will not be allowed as deduction. And now even Finance Act 2022 has made a very clarification over here in point number C, that if you compound an offense, that cannot be allowed as deduction under the head PGBP. Next one, you are making some payment to gundas, to police, For what? As a precautionary measure, so that they should not trouble you. The gundas should not trouble you. The police should handle the gundas. The police should handle the gundas without me making the bribe. It is their duty and responsibility to handle that gundas and protect me. And if you are making some bribe to them, that shall not be allowed as deduction under the income tax law. Next one, Orient Ceramics and Industries Limited. What has happened in this case? I am buying some glow sign board for my classes, Aarish Khan classes. Whether that will be allowed as a revenue expenditure or capital expenditure. The Delhi High Court has held that it is a revenue expenditure. It is not a capital expenditure. It is not permanent in nature. It has a short life. It decays with weather. It requires frequent replacement, and therefore there is no asset which is in existence, and therefore it shall be allowed as what? As a revenue expenditure and not as a capital expenditure. Next one, Shri Rama Multitech 2018 Supreme Court. What has happened in this case? The company has raised some application money. After raising the application money, the company has put that application money in the bank. From that, the company has earned some interest. Whether that interest will be taxable as IFOs or that interest should be knocked off against public issue expenses. There are two possibilities. Either that interest should be treated as income from other source, or it can be treated as, it can be set off against a PGBP income. It can be treated against an issue expenses. So the Supreme Court has held that interest should not be treated as IFOs. That interest should be set off against share issue expenses, because the money is also raised for the purpose of share issue. So it should be set off against the expenses in relation to share issue. Okay. Next is CIT versus PVR. Priya Village Roadshow is your PVR cinema. What they have done, they have incurred some expenditure on feasibility report, feasibility study they have conducted to start a new venture. But that unfortunately did not lead to what? A business. That asset was not created. So what is the expenditure? On what? Feasibility study conducted for examining proposal, etc., which was abandoned without creating a new asset. So they were planning to start with a new project, but unfortunately that did not start it. So whatever expenditure they incurred on feasibility study, etc., that will be allowed as a revenue expenditure, because there was no creation of any asset under the income tax law. Okay. Next one, last case law but not least, National Cooperative Development Corporation versus CIT 2020 Supreme Court. When you incur an expense under 37(1), is it necessary to identify the source from where the money is come? It is not necessary. The source of the fund is not necessary. The source of the fund might be from taxable income. The source of the fund might be from exempt income. It doesn't matter. 37(1) does not speak about the source of the fund from where the money has come. It only speaks about that you have to incur the expenditure for the purpose of business and profession. Now, there are a few more points which I have put over here. First one is dividend not allowed as a deduction because it is an appropriation. Income tax, wealth tax, surcharge, health and education cess, all of them are not allowed as deduction. These are personal taxes. Provision for loss of subsidiary not allowed. Deferred tax not allowed. Provision for diminution in the value of asset not allowed. Provision for uncertain liability also not allowed. Prior period expenses by default not allowed. Prior period expense by default not allowed. But if the liability is crystallized in the current year, you were not aware of that prior period in the last year, but now you are aware of that prior period expense in the current year, then it shall be allowed as a deduction to you in the current year. And last but not least, salary and perquisites paid to directors are fully allowed because directors are employees of the company, but it has to be within the limits of 48(2). That is, it should not exceed what? The amount which is mentioned under 48(2). And therefore, can it exceed the amount which is mentioned in the Companies Act? The excess amount shall be disallowed if you pay more than what is mentioned under the Companies Act also. Check it once. This is what your 37(1) is all about. Okay. So now let's move ahead with the next one, and the next one is disallowances, and there are two types of disallowances under income tax law. One is there under section 40 capital A and another is there under section 40 small a. Let's talk about section 40 capital A first of all, 48(2), which talks about that if you make excess payment to relative which is unreasonable, excessive, beyond the legitimate needs of the business, it is greater than the FMV, then the excess expenditure will be disallowed under the income tax law. Secondly, this section is only applicable to expenditures. It is not applicable to incomes. So if you sell to your related party at a lower price, then this section is not applicable. But if you make payment to your related party at an excessive price, then it is disallowed. For example, 1 lakh is the FMV. You are making a payment of 1,50,000. Then 50,000 will be disallowed. But if 1,50,000 is the FMV and you are selling at 1 lakh, then 50,000 will not be disallowed because this section is only applicable to expenditures and not applicable to incomes. But ICI makes mistakes in some of the solution, and that is the reason I have written over here. Now, who is a related party? So for that, there is a specific definition which is given over here. In case of individual, spouse, brother, sister, lineal ascendant, lineal descendant will include what? Parents, grandparents, children, grandchildren, all of them will be lineal ascendant and lineal descendant. So in case of individual, these are the related party. In case of HUF, who is the related party? The member of the HUF is a related party, and the relatives of the member is also related party of HUF. The same is the case with the partnership firm and company and AOP VOI also. Partners, directors and members are the related party, and their relatives are also related party of the firm, LLP, company and of AOP VOI. Similarly, if assessee has a substantial interest in any entity, substantial interest means what? 20% stake at any time during the previous year in any entity, then the assessee and that entity is also related party. And last but not least, holding subsidiaries are also what? Are related party. Let's move on to the next section, which is one of the most important section for your exam in the chapter of PGBP, because it will have a great impact in your questions in form of disallowances. 48.3. When you make a payment of a revenue expenditure to any person in a day, when you make a payment of revenue expenditure to a person in a day in excess of 10,000 rupees, then you have to make the payment by 4 modes: account pay check, account pay draft, ECS, or such other electronic mode. Sir, bearer check would be fine, bearer check will be disallowed. Sir, cross check will be fine, cross check will also be disallowed. We want account pay check, not cross check. Just crossing will not be sufficient. You have to cross and write down over there account pay, then it is allowed, otherwise it is disallowed. Sir, what comes under such other electronic mode? You can see the list over that. Rule 6 ABBA, credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT, BHIM, all of them are covered under what? Under the such other electronic mode as may be prescribed. Now, if you make the payment in excess of 10,000, then you have to make by 4 modes, otherwise disallowed. But for road transporter, if you make the payment to a road transporter, then the limit is increased to 35,000 rupees. Sir, what will happen if I have debited one expenditure in 1 year and claim deduction on accrual basis in 1 year, and next year I make the payment in cash? Then in that case, in next year, it will be added back to your income and it will be considered as your deemed income. So in one financial year, you claim the deduction on accrual basis, and in another financial year, you make the payment by other than 4 modes, then it will be deemed to be income of the next financial year. Okay. Now this section is only applicable to what? Revenue expenditure. For capital expenditure, we have already done that. In 43.1, there is a particular proviso which says that you should not buy a fixed asset of more than 10,000 rupees and make the payment to a person in a day other than 4 modes. Even in 35.80, we have seen that in 35.80, if you want to take the deduction, more than 10,000 rupees to a person in a day should be other than the 4 modes. If you make the payment, then it will be disallowed. Okay. Now there are certain exceptions which are made by the government, whereby you can make as much payment as you want in cash. So which are those exceptions? The first one, it is given under Rule 6 DD. If you make the payment to RBI, if you make the payment to LIC, if you make the payment to bank or government, it is allowed. If you make the payment by book entries, it is allowed. If you make the payment to purchase agriculture produce, forest produce, poultry produce, dairy product, fish product, livestock, from whom? From the store, from the big bazaar, from the supermarket. No, you have to purchase these products from producer of these products. If you purchase these products from the producer, cultivator or grower of these products, then you can make the payment in cash, it is allowed. Next, if you make the payment of what? Up to 50,000 for retirement benefit, it is allowed. Like if you make the payment of VRS, if you make the payment of gratuity, if you make the payment of PF, up to 50,000 cash, it is allowed for those people. Higher limit has been prescribed by the government. Next, if you are sending your employees to outside the state, outside the place of work for some job, or if you are sending your employees on a ship for 15 days or more, and where he is going there is no bank account, and you are deducting his TDS, then you can do what? You can make the payment in cash to that employee. An employee is going out of your place, normal place of business, and the ship, he is going on ship for 15 days or more, and he does not have a bank account at that place, and you are deducting his TDS, then you can make the payment to him in cash. You are making a payment to a person where banking facility is not available, you can make the payment in cash. You are making to a person who is an agent who purchases or sells on behalf of you the goods and services. In that case, you can make the payment in cash. You are an authorized dealer, you yourself are an authorized dealer. An authorized dealer is making payment in cash, or you are a money changer, you are a forex dealer, and you are a money changer or forex dealer, and if you are making payment in cash to someone, it is allowed in your case. And last but not least, you are purchasing some products from a cottage industry which is manufactured without the aid of power. So you are purchasing some product from cottage industry which is manufactured without the aid of power, then in that case you can make the payment in cash, it is allowed. Now there is one clarification which was required from CBDT. So CBDT has come forward and clarified that. What is the clarification? It is written above in one of the point that if you want to purchase fish and fish product, you can purchase fish and fish product, but you have to purchase from the producer of the fish. So there are two questions which were raised by the industry. First question, what does fish and fish product include? Because fish and fish product might include a lot of things. So CBDT has clarified that fish and fish product includes not only fish, it will also include shrimps, prawns, cuttlefish, squids, crabs, lobsters. All these things will also be part of fish and fish product. All the marine products will be considered as the fish and fish product. Second thing, you have to purchase from the producer of the fish and fish product. Who is producer of fish? Who the hell in this world produce fish here? Fish are automatically what? Breeded in the water. They are not produced by anyone. So the CBDT has further clarified that the fisherman will be considered as a person who produces fish. The producer will be the fisherman or the headman of the fisherman who sorts the catch of the fish. Suppose there is one headman who has put all the fishermen in the water and said them that you have to catch the fish and give it to me. So in short, one person who is catching the fish, that person will be called as what? A fisherman. If you purchase the fish and fish product from that person, you can make the payment in cash to them. If you go to the supermarket and buy the fish and fish product from there, then you cannot make the payment in cash to them. You have to make the payment by 4 modes. Then there is a circular over here which I'll be dealing later on, because that is dependent on section 269 ST also. Whenever that section will come, I'll be dealing that circular with that particular section only. I'm not dealing that as of now. Now there is a linking of 48.2 and 48.3. Suppose if you are making 1 lakh payment to your related party in cash, then what will happen? And your fair market value is only 20,000 rupees, but you are making 1 lakh rupees payment in cash to related party. So in that case, you are making excess payment to related party. Yes. Are you also making the payment by other than 4 modes? Yes. So both the sections are attracted. So in that case, what has to be done? The law says that in such case, first apply 48.2. First apply 48.2 and disallow the excess amount. So 48.2 I applied and 80,000 I will disallow because fair market value is 20,000. You are making the payment of 1 lakh. So 80,000 disallow. Then see the leftover amount. What is the leftover amount? 20,000. If that amount is greater than 10,000, then disallow that amount also. And if that amount is less than 10,000, then don't disallow anything. This is what the law has to say. You can check this over here. Is it clear? Then, where is a special? There is a very special case which is given under section 40A subsection 4. Listen carefully. I am a buyer. You are a seller. We enter into a contract that I will buy something from you worth rupees 2 lakhs. And you have said that yes, you will also sell me something worth rupees 2 lakhs. And one more important thing which we have written in the contract, that I will buy the goods from you and I will make the payment in cash only and cash only. It means I will make the payment in cash of 2 lakh rupees. It is written in the contract. Now, it is also written in the contract. If I don't make the payment in cash, you can sue me and you can put me in jail. So when the date of payment came, I made the payment by account pay check. So I am violating the contract. So the question is, can you sue me? In that case, the government of India has said that no, that person cannot raise any question on you if you make the payment by account pay check, account pay draft, ECS or such other electronic mode, to protect the spirit of section 48.3. So if you make the, even though it is written in the contract that you have to make the payment in cash, even if it is written in the contract that if you do not make the payment in cash, you will be in jail, still the government says that if you make the payment by account pay check, account pay draft, ECS, such other electronic mode, you will not be, there will not be any question, there will not be any suit, there will not be any case which can be raised against you by any person in this world. Okay, so this is what this section tells you. It protects you to make the payment by what? By the 4 modes which the government has said. Next, if you make the payment of provision for gratuity, if you make any provision for gratuity in the books of accounts, that is not allowed. Provision for gratuity is not allowed. But if you make actual payment to the employee by putting that money in the bank account of the employee, at that day we are going to give you the reduction. Suppose you made a payment, you made a provision of 5 lakh rupees in your books of accounts. Gratuity account debit to provision for gratuity, 5 lakh disallowed. But out of that 5 lakh, suppose next year if you make payment of 3 lakh rupees to the employees, then that 3 lakh will be allowed as deduction to you under the head PGBP. Moral of the story is very simple. Provision for payment of gratuity not allowed, provision not allowed, actual payment allowed. Okay. Next one, 48.9. If you make some contribution to unrecognized provident fund, which provident fund? Unrecognized provident fund, then it is not allowed, because in section 36 subsection 1 clause 4, only if you make contribution to a recognized provident fund, then only it is allowed as deduction. Unrecognized provident fund contribution is not allowed under the income tax law. Now coming to what? Section 40 small a, the first TDS section, the first disallowance section under section 40 small a is regarding TDS, which says that if you make the payment to non-resident or if you make the payment to certain foreign companies, and if the income of the other person is chargeable to tax in India, the income of the other person has to be chargeable to tax in India, then you have to deduct TDS in the same financial year. You have to deduct by 31st March and you can make the payment till the due date of filing of return. If you deduct by 31st March and make the payment till due date of filing of return, then the expenditure will be disallowed. But if you do not deduct in 31st March, if you do not deduct by 31st March, that it means if you deduct in the month of next month, April, or if you deduct on the March but do not pay till the due date of filing of return, then 100% expenditure will be disallowed in the current year. So what 2 things you have to do religiously? Deduct in the same financial year till March and pay till the due date. If you violate any of the condition, then the expenditure will be disallowed in the current year. Is it a permanent disallowance? The answer is no. It is not a permanent disallowance. It is disallowed in the current year, but whenever you will make the payment next year, it will be allowed as deduction to you in the next year. Don't worry. It's not a permanent disallowance. It's a temporary disallowance which is done under the income tax law. Secondly, the payment which I am making should be chargeable to tax in the hands of the other person. Then only deduct TDS, or else don't deduct TDS. Now, what if the payment which I am making to the other person is partially chargeable to tax in the hands of the other person? If it is partially chargeable, not fully chargeable, then you have to go to the assessing officer, make an application to the assessing officer. Assessing officer will tell you how much portion is taxable, how much portion is exempt, only that much portion has to be subject to TDS. And if you do not deduct TDS, only that much portion should be disallowed. For example, I am making a payment of 5 lakh rupees, but I don't know how much is taxable, how much is exempt, because it is partially taxable. So I have to go to assessing officer. Now, if assessing officer says that 40% taxable, so out of 5 lakh, 40% taxable. So I have to deduct TDS on 2 lakh rupees. If I do not deduct TDS on 2 lakh, only 2 lakh will be disallowed. Entire 5 lakhs will not be disallowed under the income tax law. Is it clear? I hope it is clear to all of you. The next one is, let's go ahead. So the next one is exactly similar to the previous one only. That only difference is here you are making payment to resident payee, and here the disallowance will be 30%, not 100%. There, if you do not deduct, do not pay on time, then it is 100% disallowed. But here it is only 30% disallowed. Okay. In the next year, if you make the payment of TDS, then it will be allowed. 30% will be allowed to you in the next year. Okay. It is as simple as that. Now, one thing which is common in both the section, which I have not told you in the previous section also, because I thought that I'll speak about that very important provision in both the sections together over here. Suppose I am a deductor, you are a deductee. Generally, what happens if the deductor does not deduct TDS? Be very careful, and very important provision. Generally, if the deductor does not deduct TDS and if the deductor does not pay the TDS, then it is tagged that deductor is a assessee in default and he has to bear a lot of consequences under the income tax law. But now the government has given some relaxation to the assessee, whereby the government has said that if the deductor does not deduct the TDS and if the deductor does not pay the TDS, but if the deductee has included that income in his income tax return and deductee has paid the tax and deductee has filed the return, then it is deemed that the deductor has paid the tax and deductor has deducted the tax on the date on which the deductee has filed the income tax return. So be very careful. By default, I have not deducted the TDS, I have not paid the TDS, but the other person has included that income in his income. He has filed the ITR, he has paid the tax. So it will be deemed that I have only deducted. Actually, I have not deducted, but it will be deemed that I am only deducted, I am only paid on which date? On the date on which he has filed the return. The other person has filed the return. And in accordance to that, what will happen in the current year? That expenditure will be disallowed because it is deemed that it is deducted in the next year. So in the current year, the expenditure will be disallowed, but this expenditure will be allowed to you in the subsequent year. Don't worry about it. But will I be liable for any interest? Yes, there is one marginal interest which you have to pay, that is 1% per month or part thereof, from the date on which you are liable to deduct the TDS till the date on which the other person has filed the return. So that much period you have to pay interest at the rate of 1% per month or part thereof. Okay. Now. The expenditure will not be disallowed? No, the expenditure will not be disallowed. Now, there is one Supreme Court judgment over here which has given two clarifications. First clarification, there was unnecessary doubt in the mind of certain assessees. One was, is TDS only applicable to those people following mercantile system, or is it also applicable to those following the cash system also? So the Supreme Court has clarified that TDS has nothing to do with your method of accounting. Method of accounting is for maintaining books of accounts. It's not for deducting TDS. Whether you are following what? A mercantile system of accounting, then also TDS is applicable. Whether you are following cash system of accounting, then also TDS is applicable. So this is the first clarification the Supreme Court has given in the case of Palam Gas Service. Now the second clarification which the Supreme Court has given, be very careful. There was a doubt in the mind of people that if the payment is made in the current year, that is, I have made the payment, say April month payment I have made in the month of May. So if the payment is made and on that amount if I have not deducted TDS, then TDS provisions are not disallowed, then disallowance provisions are not applicable. Let me give you an example. For example, April payment I have made in the month of May, May payment I have made in the month of June, but March payment I have not made so far because that is outstanding, that is payable, that will be paid in the month of April. So some people were saying that this provision of disallowance is only applicable if the amount is payable, that is only for the outstanding amount. It is not applicable for the amount which is paid during the financial year. So the government of India, so the Supreme Court came up with a clarification which says that Section 40A1 and 40A1A has nothing to do with all these things. Whether you have made the payment in the entire financial year or whether you have not made the payment, the amount is still outstanding in the entire financial year, it doesn't matter. TDS disallowance will be applicable in both the cases. Okay. Next, there are some small disallowances which are there over here. Of 40A2, very important disallowance, income tax is disallowed. But again, there was some doubt in some people's mind, will income tax include surcharge and cess also? So Finance Act 2022 has clarified that yes, income tax will include surcharge and cess also. And there is a related amendment which we'll see later on in section 155.15. We'll be talking about that amendment later on in 155, which has a link with this particular provision. Don't worry. Okay. So by default, income tax will be disallowed, and even health and education cess and surcharge will be disallowed. Wealth tax will be disallowed. It's as simple as that. Next one, 48(2)(b) is if any state government undertaking is making some payment of royalty, service fees, service charge, exclusively charged to state government undertaking by the state government, then that will be disallowed. For example, if there is a Maharashtra state government undertaking which is making some payment to Maharashtra government itself in the form of royalties, service charge, service fee, then the government says that that shall not be allowed as deduction under the income tax law. And last but not least, 40A5, what does this say? This 40A5 says that if you make a payment of tax of non-monetary perquisites of your employees, first of all, you are giving non-monetary perquisite to employee, and now you are bearing the tax also of that employee. So the tax which you are bearing of non-monetary perquisites of the employee on behalf of the employee, what employer is bearing, that tax will be disallowed under 40A5, and that perquisite will be exempt in the hands of the employees under section 10(10)(c). And one last thing is over here, 40A3, if you make the payment of salary to non-resident outside India, if you make the payment of what? Salaries to non-resident, and if you do not deduct TDS, and if you do not pay the TDS on time, then the salary expenditure will also be disallowed under the income tax law. So the salary disallowance is not covered in 40A1. 40A1 covered all other expenses other than salary, and for salary you have to follow 40A3. Now coming to the master section of what? Disallowance. There are certain expenditures under the income tax law which are allowed only on actual payment basis. Now which are those expenditures? 43B talks about that, and it's an overriding section. It overrides all the other provisions of the income tax law. So first of all, there are around 7 expenditures which are allowed on actual payment basis. First, tax, duty, cess and fee will be allowed on actual payment. Second, employer's contribution, not employee's contribution. Be very careful. Employer's contribution to certain provident fund, gratuity fund, etc. will be allowed as deduction if you make the payment till the due date of filing of return. Because in 43B, the date is the due date of filing of return. What about employee contribution? There is a stricter time limit. You have to make the payment by 15th of the next month. But for employer contribution, you can make the payment till the due date of filing of return. It's all fine. Third, bonus or commission to employees allowed on actual payment. Fourth and fifth, interest and interest from public financial institution, state financial institution, state industrial investment corporation, then from NBFCs, then from scheduled bank, then from cooperative banks. If you take loan from these people, you make the payment of interest to them, then it is allowed on actual payment, not on accrual basis. Then leave salary, and then last but not least, if you make some payment to Indian Railways for using their asset, you have to make the payment, and then only you can claim deduction. Otherwise, you cannot claim deduction. By when am I supposed to make the payment? You have to make the payment till the due date of filing of return. You will get the deduction. What if I don't make the payment till the due date of filing of return? If you don't make the payment till the due date of filing of return, then the expenditure will be disallowed in the current year. But whenever it will be actually paid, it will be allowed in that financial year. So again, this section is what? A temporary disallowance. It is not a permanent disallowance. What if I am supposed to pay some sales tax liability to the government, and what if instead of paying the sales tax liability, I give a bank guarantee to the government? Will I get the deduction? Giving of bank guarantee does not amount to what? Actual payment. You have to make actual payment to the government. Bank guarantee is just you are giving some kind of satisfaction to the government that yes, I'll be making the payment. That is not actual payment. Giving a bank guarantee does not amount to actual payment, and therefore it shall not be allowed as deduction. Next. Am I supposed to pay? Is the GST will be allowed on actual payment? Yes. It doesn't matter whether now the GST is inclusive of turnover or GST is exclusive of turnover. If it is inclusive of turnover, then also it is allowed on actual payment. If it is exclusive of turnover, then also it is allowed on actual payment. Moral of the story, if you route GST through PNL, then also it is allowed on actual payment. If you do not route GST through PNL, then also it is allowed on what? Actual payment. Then certain very important clarifications which has been issued by the Government of India. Suppose there is an outstanding interest in your balance sheet, and if you convert that outstanding interest into a new loan, the government has very clearly said that conversion of outstanding interest into a new loan will not be considered as what? As an actual payment. You have to actually pay to the bank, then only it can be allowed as deduction. Second question, what if I convert that outstanding interest into a debenture? What if I convert that outstanding interest into a security or bond? So Finance Act 2022 has clarified, even that cannot be considered as what? Actual payment. So now conversion of an outstanding interest into a new loan, not allowed. Into a new security, debenture, bond, not allowed. When it will be allowed then? Whenever that new loan will be actually paid to the bankers, that time we will allow you the deduction, irrespective of the nomenclature at that time. So when you will actually make the payment of that loan to the bank, that time we are going to give you the deduction under the income tax law. And one last thing is the Supreme Court judgment of Sassoon Chemicals and Drugs Limited, which says that there was an assessee. There was some dispute regarding payment of bonus to the employees. So what assessee did? He formed a temporary trust for a time being, and he made the payment to trust. and before the due date of filing of return, very important line, the matter got resolved and the trust made the payment to what? To the employees. So will the assessee be allowed the deduction? Absolutely yes. There is no harm in that. Before the due date of filing of return, everything was sorted out, and therefore before the due date of filing of return, for safety purpose, I gave that money to a particular trust, and before the due date of filing of return, the matter was solved with employees, so the trust made the payment to the employees. So why it should not be allowed as deduction to the assessee? I don't understand why such kind of case laws goes to Supreme Court unnecessarily. Okay. Just go through it once. Here we complete all the disallowances under the income tax law. So now let's move on to the next part, which is a very small part, and that is deemed income. There are two sections which we have to see over here. One is 41.1 and another is 41.4. Let's talk about 41.1 because this section has multiple parts. First is when you incur any loss or expenditure and you take that as a deduction, and subsequently in subsequent year, if you recover that loss or you write off that loss, or if you write off that particular liability, then in that case it is deemed to be business income under the head PGBP. And that happens even if the business is ceased to exist, even if your business is closed, and after that if you write off, if you recover the amount, your business is closed, after that you recover some amount from your customer, from your expenditure, then that is also subject to charge. Even if there is an amalgamation etc. in your case, and if there is an amalgamation and you have claimed that deduction and it is recovered by the amalgamated company, then also it is taxable in the hands of successor. Be very careful with these 2 points. Okay. Now, if there is a remission or cessation of a trading liability, what do I mean by trading liability? For example, I have taken a working capital loan and that loan is waived by the bank, then that is known as remission or cessation of a trading liability. That is also a deemed income under 41 subsection 1. But if there is a remission and cessation of a capital liability, like if I take a loan for a fixed asset, then it is a remission and cessation of a capital liability, then that cannot be considered as what? As a deemed income under section 41.1. These discussions we have already done in the chapter of depreciation, that if the loan is taken for fixed asset and it is waived by central government, state government, any body agency, then it is income, and if it is waived by company, firm, LLP, then it is not taxable as an income. We have done this discussion in the chapter of depreciation under section 224 clause 18. Okay. Then comes the next one. If there is a unilateral cessation of trading liability, then that is also income. What is unilateral cessation of trading liability? There is a seller and there is a buyer. So seller is booking the debtors of 1 lakh and buyer is booking the creditors of 1 lakh. Now, if the buyer knows that he is not going to pay the tax, he is not going to pay the money to the seller. But if the seller says that no, I will recover the money from you, so seller will not write off, but the buyer will unilaterally write off. So writing off unilaterally a liability without the seller being writing off the debtors as bad debts, then also that income is also chargeable to tax in the hands of the assessee. You should not think about what the other person does. What you are doing, that is more important. If you are writing off the liability unilaterally, then that shall also be disallowed under the income tax law. Now, there is a very important judgment of Supreme Court in the form of Polyflex India Private Limited. What has happened in that case? This case law was with respect to excise duty long back in 1990s. So there was some dispute regarding excise duty. So the government said that you have to pay this excise duty. So the assessee paid excise duty and filed a case in High Court, and the matter went to High Court. So assessee, when paid excise duty, obviously took the deduction of excise duty on actual payment basis, because excise duty was allowed on what? Actual payment basis under 43B. So assessee made the payment of excise duty and then claimed the deduction under 43B and then filed a case in High Court. The matter went to High Court. After a few years, the High Court said that the assessee is correct, so the department has to give the refund back of excise duty which is paid by the assessee. The department gave back the excise duty to the assessee as the refund. Now immediately the department filed a case in Supreme Court. So now the AO says that because the assessee has got the refund, assessee has to pay the tax under 41.1, it will be deemed income. But the assessee is making a contention that because the matter is subjudiced in the highest court of India, that is the Supreme Court, we will not pay the tax on receiving this money as refund. We will pay the tax when Supreme Court gives the judgment. So the question is, should we wait for the Supreme Court judgment to charge deemed income, or should we charge the deemed income on the day on which we receive the money from the government in the form of refund? So the Supreme Court in this landmark judgment held that you do not have to wait till the Supreme Court judgment. You have to pay tax the moment you receive the money on respect of an expenditure which was allowed as deduction earlier. Was the excise duty allowed as deduction? Yes. Are you getting the refund of that excise duty? Yes. The moment you do this, you have to pay tax on that. That's it. You have to pay tax on that. That's what the court has held that in this particular case. Now, there is one more point which you need to keep in mind. Suppose the court has given an order that you have to give refund to the assessee, but the government has not given the refund. Then the amount will not be taxable. Only giving an order will not be subject to tax. Order should be supported by what? Actual refund. Then only it will be subject to what? Tax in the hands of what? In the hands of the assessee. Then comes the recovery of bad debts. If there is a bad debts which you have claimed under section 36(1)(7), and later on if you recover that bad debt from the customer, then it is deemed income under section 41(4). And here the government has given further relaxation. It was held by Supreme Court in the case of PK Kemal that if the debt was sold by, debt was written off in the hands of the amalgamating company and it was recovered by amalgamated company, then also it is not taxable. So in this case, if there is a change of assessee, then it is not taxable, and if there is no change of assessee, then it is taxable. Okay. Now apart from this 41(1) and 41(4), we have done many other sections under section 41, like 41(2) we have done under the chapter of depreciation balancing charge, 41(3) we have done under scientific research, we have already done this, 41(4)(a) we have done under transfer to special reserve, 41(5) we will be doing later on in the chapter of what, set off and carry forward. So these are some of the important sections which we have done. These two are very important, 41(1) and 41(4). Rest of them are not very important as far as exams are considered. Okay, let's move on to the next one. That is, some miscellaneous issues are there over. First miscellaneous issue over here is the discussion on 14A, 14A, 14A. What does 14A has to say? 14A says that if you incur an expense to earn an income which is exempt under section 10, then that expenditure will be disallowed in a prescribed manner. And who will decide that prescribed manner? Assessing officer will decide that prescribed manner as per Rule 8D. So how much is disallowed? Rule 8D talks about how much is disallowed. So in this there are 2 points which the government has given. One is, if you incur an expenditure specifically for exempt income, then that though will be fully disallowed. So if you have taken a loan which is specifically for tax-free bond, then that loan ka interest will be definitely fully disallowed. But if there is a general loan, then how much will be disallowed? In that case, there is a long exercise that you have to follow, which is mentioned over here. That is, you have to list down all the exempt investments which you have, and then you have to take the monthly averages of all of them. 1st April, 30th April. Which investments? Only exempt investments monthly average. 1st April, 30th April. 1st May, 31st May. 1st June, 30th June. 1st July, 31st July. Like that, 12 months monthly average has to be taken of exempt investments only, not all investments. After that, 12 monthly averages you have got, yes, then total all of them, and then divide by 12, you will get annual average. After that, whatever amount will come, you have to take 1% of that, and that will be the disallowance under point number 2. First, you have to take monthly average of exempt investment, then you have to add all the 12 monthly average, divide by 12, and then you have to take 1% of that. That will be the disallowance under section what, 14A, which is a part of this particular section, point number 2. Now there are some circulars which are there over here, and that circular is clarified by Finance Act 2022 in the form of a law. Now, what is that circular? Suppose I took a loan in the current year for exempt income, but I did not earn exempt income in the current year. I earned exempt income in the subsequent year. Will the expenditure be still disallowed? Because in the current year, I am not earning any exempt income. The circular says that yes, whether you take a loan in the current year and whether you earn exempt income in the current year or in the future year, it doesn't matter. What matters is that loan is for exempt income, and whatever interest expense you have incurred for that exempt income, whether earned in the current year, it will be earned in the future year, it will be disallowed. So this is what this circular has to say in 2014. And in Finance Act 2022, the government has clarified this circular through a separate law. The government has put a special provision under 14A which says that the expenditure will be disallowed irrespective of whether the exempt income is earned in the current year or it is earned in the subsequent year. It doesn't matter. Last but not least, over here in 14A, that is, what will happen if I incur some expenses to earn an income which is deductible under chapter 6A. I am not incurring the expenses to earn the income which is exempt under section 10, but I am incurring an expenditure to earn an income which is deductible under chapter 6A. So the Supreme Court, the Delhi High Court has said that then the disallowance under 14A will not be applicable. Disallowance under 14A is only applicable for expenditure which is incurred for earning exempt income and not for earning incomes which are deductible under chapter 6A in the form of profit linked deductions or any other deduction. Okay. Now coming to the next one, small section is there which is for banking industries, scheduled bank, public financial institution, cooperative bank, NBFCs. For them, the government said that whatever their bad debts is there, bad and doubtful debts is there, of that interest income, when they will recognize that interest income. So every bank has some provision for bad debts. On that, suppose the bank has given you a loan of 10,000 crore. Out of that, the bank feels that 2,000 crore is provision for bad debts, not actual bad debts. So on that 2,000 crore, when the bank will recognize the income, on that 2,000 crore also they will give, they have to recognize the income and pay the tax on the interest income, right? So on that 2,000 crore, which is provision for bad debts, bad and doubtful debts, on that income, on that 2,000 crore, which is provision for bad and doubtful debts, on that, when the interest income will be recognized, so the government has made a special provision for them and says that that has to be recognized on the day on which it will be recovered by the bank or on the day on which it is credited in the books of accounts, whichever is earlier. So whenever you will recover that amount from the customer or whenever you will credit that amount in the books of accounts, whichever is earlier, at that time you are supposed to what? Pay tax on that. Just go through it once and then we'll move ahead with the next part. So now let's go ahead with the next one, and next one is if you are following PGBP, then you have to maintain books. So who is liable to maintain books of accounts? That is mentioned in section 44AA, who is liable to maintain books of accounts. So for that purpose, the government has categorized all the assessees into two categories. One is certain specified professions and others are mentioned in the below mentioned table. So specified professions include like chartered accountancy, lawyers, doctors, film artists, etc, etc, etc. Certain noble and notified professions are mentioned above and rest of them are mentioned in the below mentioned table. So let's talk about the specified profession. When the specified professional people are liable to maintain books of accounts, if they are existing in nature, they are working since so many years, then they are liable to maintain books of accounts in the current years if their gross receipt is greater than 1.5 lakhs in all the three financial year. In all the three preceding financial year, if the gross receipt is greater than 1.5 lakhs, they are liable to maintain books of accounts in the current year. And if you are a new professional, then you have to check if it is likely to exceed 1.5 lakhs in the current financial year. So for how many years you are supposed to maintain the books of accounts? You are supposed to maintain the books of accounts for a period of 6 years from the end of the relevant AY. So you have to maintain it for 6 years from the end of the relevant AY. What about other than specified professionals? So other than specified professionals, the government has made two category over here also. There are further two subcategories. For individual and HUF, there is a slightly higher limit, and for other than individual and HUF, there is slightly lower limit. Now, in this also there are further two categories. If you are an existing businessman or existing professional, then you fulfill either of the two conditions, you are trapped and you are supposed to maintain the books of account. First, if PGBP exceeds 1.2 lakhs or 2.5 lakhs depending upon the assessee in any of the last 3 years, here the word used is any, here the word used is all, be very careful. Or if this is not exceeding 1.2 lakhs or 2.5 lakhs, then if your turnover in any of the last 3 years is greater than 10 lakh rupees or 25 lakh rupees, then also you are supposed to maintain what? You are supposed to maintain the books of account. So you can get trapped anywhere. You can get trapped here also. If you are not getting trapped here, then you will get trapped here. Either of the conditions if you fulfill in any of the 3 years, out of the 3 years, even if you fulfill the condition for one of the year, you have to maintain the books of accounts in the current year. Then for what about the new business and profession? So if you are a new business and profession, this is your first year of business, then you have to check these conditions in the current financial year. Obviously, you cannot check it for the earlier year. Now, what if I do not maintain the books of accounts? I am liable to maintain the books of accounts, but I still do not maintain the books of accounts. The AO or the CIT appeal might impose a penalty of approximately 25,000 rupees on you for not maintaining the books of accounts under section 271A. Okay, let's move on to the second part, and that is tax audit. Who is liable to maintain tax audit? Who is liable to do tax audit? For businesses, there are two limits. One is if your turnover exceeds 1 crore, you are liable to do tax audit. Second, if your 95% of the payment and 95% of the receipt is online, it means your cash payment and cash receipt should not exceed 5%. So if your cash receipt is not exceeding 5% of total receipt, and if your cash payment is not exceeding 5% of total payments, then for you the total turnover limit, the tax audit turnover limit is 10 times increased to 10 crore rupees. So if your 95% transactions are online, then you have a higher tax audit limit of 10 crore. So what does cash include? Cash includes not only hard cash, but it will also include bearer check. Bearer check is as good as cash only in the eyes of the law. That is what is written over here. The bearer check will also be cash. The account pay check will also be cash. The cross check will also be cash. What will not be considered as cash as what? Which is an account pay check. So if your cash is hard cash, it is cash. If your cash is, if you accept or give bearer check, that is also cash. If you accept or give normal cross check, that is also cash. You have to receive or make the payment by account pay check, account pay draft, and all those electronic modes which are mentioned by the government. Okay. Now third case. For professional, the turnover of gross receipt should exceed 50 lakhs. Then you are liable to maintain what? You are liable to conduct the tax audit from a chartered accountant. For assessees opting for 4480, for them the tax audit limit is higher, that is 2 crore rupees. So up to 2 crore turnover, they are not liable to do what? Tax audit, because for them under 4480, the limit under 4480 is 2 crore rupees. Okay. Now, what is the due date of tax audit? The tax audit due date is 1 month prior to the due date of filing of return, and that means if you are filing the return on 30th November, then the tax audit will be conducted on 31st October, and if you are filing the return on 31st October, then the tax audit will be conducted on 30th September. That is as the case may be. What is the penalty if I do not conduct the tax audit? If you do not conduct the tax audit, then there is a penalty under 271B of 0.5% of turnover or 1,50,000, whichever is lower, not higher. Be very careful. Whichever is lower is the tax audit penalty. Now, there are certain issues which are there over here, which I'll let you know one by one, but I'm giving you a general principle. What is the treatment of expenses in relation to shares issued, debentures issued, long-term borrowings, etc.? What will be the treatment of those expenses which are in relation to issue of shares, issue of debentures, issue of long-term borrowings, etc., etc., issue of bonds, etc.? The law is very simple. If you incur any expense, I'm just telling you the fundamental principle of 9 case laws which are mentioned over here one by one. Nobody will teach you so much in CA final in great depth, the way we are trying to do it over here, even in the revision videos. So if you are incurring some expenses in relation to an expenditure which will lead to eventually what? Permanent capital of the company, and then that expenditure will be treated as a capital expenditure. So if you incur any expenses which has an intention of increasing the permanent capital of the company, then that expense will be considered as a capital expenditure. Apart from that, the expenditure will be considered as a revenue expenditure. But now you will ask me a question, sir, we have done all those things in 35D preliminary expense. Yes, preliminary expense 35D also cover these expenses, but preliminary expenses 35D is very specific to certain assessees. Let me tell you, it is only applicable to Indian companies, or if you're not company, then only residents. In that case also, in post commencement, your case should be a case of expansion or extension or setting up of a new unit, then only 35D is allowed. So if it is not covered in 35D, then where will I come and classify that expenditure? That's where you will come and classify your expenditure. If your expenditure is not getting classified in 35D, then come over here. If it is getting classified in 35D, then do not come over here. And if you come over here, you have to apply the fundamental principle. If you incur an expense which is for what? Increasing the permanent capital base of the company, then that expenditure should not be allowed. It is a capital expenditure. Let's see one by one. You are incurring some expenses for increasing the authorized capital of the company. Your intention is to increase the permanent capital base of the company, because increasing the authorized capital will eventually lead to increasing capital of the company later on in future, and therefore that expenditure is a capital expenditure, not allowed as deduction. Second, if you incur some expenses to increase what? To raise some share capital in the company. So if you are incurring some expenses to raise the share capital in the company, that will lead to increase in the permanent capital base of the company, and therefore that expenditure is the capital expenditure. If you incur some expenses for bonus shares does not increase the capital of the company. It is mere capitalization of the reserve, and therefore there is no fresh funds which are coming to the business, and therefore this expenditure which is incurred for issuing bonus share does not increase the capital of the company, and therefore that expenditure will be treated as what? As a revenue expenditure. Next, if you incur some expenses for raising loans or debentures, it is fully allowed. It is considered as a revenue expenditure. Next, if you issue some debentures on discount, and that debentures are issued at a discount of say 3 rupees per debenture, so total debenture you have issued for 15 crore and you are issuing at 12 crore rupees, 3 crore discount, so that discount will be allowed as deduction over the life of the debenture. Don't worry. Next, if you are issuing some shares on the directions of the RBI, so even in that case, your expenditure is incurred for the purpose of increasing the capital base of the company. It doesn't matter whether RBI directs or SEBI directs or Government of India directs. It doesn't matter. If you are incurring expense to raise capital, then that expenditure should be allowed as a deduction under the income tax law. If you are paying some premium on redemption of debentures, you are making some premium, then that will also be allowed as deduction over the life of the debenture. Don't worry, that will also be allowed as a deduction. Next, if you incur some expenses on convertible debentures, which will be converted into equity shares in future. Now there are two views over here. Some people say that it is a debenture. Because it's a debenture, it's not a permanent asset. We have to redeem some or the other day. So the expenditure in relation to convertible debenture has to be allowed as deduction. Some people say that no. In future it will be converted into equity share, and because it will be converted into equity shares, it will become permanent part of the company, and therefore it shall not be allowed. So both the views I have mentioned over here, you can check over here. And last but not least, you were about to issue the shares, but you did not issue the shares because of the interference of the SEBI. SEBI has not given you clearance, and because of that you are not able to issue the shares, but you have incurred the expenses for issue of shares. So what will happen with that issue of shares expense? It will be allowed as deduction because your intention was to increase the permanent capital base of the company, and therefore it has to be allowed as deduction. The answer is very clear. If you incur any expense which will lead to what? Increase in the permanent capital base of the company, it shall be allowed as deduction. It shall not be allowed as deduction, sorry, because it's a capital expenditure. But if you incur an expense which is not for increasing the permanent capital base of the company, then it shall be allowed as deduction as a revenue expenditure. Okay, now coming to one of the most important topic of this chapter, that is presumptive income, 44AD. 44AD is applicable to whom? It's a presumptive income which is applicable to individual, HUF, firm, not LLP, and all of them have to be resident, and a resident. Non-resident, this section out of the section. Okay, now you need to also do eligible business. What do I mean by eligible? Any business having a turnover of up to 2 crore rupees other than the truck wala business. 44A business is excluded from here, so your turnover has to be up to 2 crore rupees. Then your deemed income will be how much? 8% of the turnover. But sir, we have heard that it is 6% also in some case. Yes, if you receive your money from the customer till the due date of filing of return by 4 modes, that is account pay check, account pay draft, ECS or such other electronic mode, then that much portion of the turnover will be subject to 6% deemed income only. It will not be subject to 8% deemed income. Okay, now this section is not applicable to certain assessees. First, this section is not applicable to assessees who claim profit linked deductions under ATIA, ATIB or 10AA deductions. If you are eligible for a profit linked deduction, if you are claiming profit linked deduction, then 44AD is closed for you. It is not available for you. Second, this section is not available to professions. This section is not available to any assessee engaged in commission business or brokerage business. Not available. This section is not available to any assessee engaged in any agency business. You have to do a proper business, not commission business or brokerage business or agency business or profession. You are supposed to do a proper business. That too, your business should not be a profit link deduction or 10AA deductions. Business should not be there. That business is not allowed to claim benefit under 44AD. Now, once I take 8% of the deemed income as my profit. Will I get any deduction of PGBP out of it? You will not get any PGBP deduction, first point. You will not be disallowed any PGBP disallowance also. That's a good news for you. No PGBP disallowance. Make excess payment to the related party. No disallowance. Do not deduct TDS. No disallowance. Make a cash payment of more than 10,000, no disallowance. So no PGBP deduction should be given effect to, no PGBP disallowance should be given effect to. Even unabsorbed depreciation should not be allowed because that is also a part of PGBP which is covered under section 32 subsection 2. Even unabsorbed depreciation will not be allowed. Sir, what about the brought forward losses? If there are some brought forward losses of earlier years, PGBP loss, that can be set off against this income because this section only overrides section 28 to 43. It does not override the entire income tax law. So if there are some brought forward losses, you can set off against this income. That is allowed to you to do. You can do that. Okay. What about chapter 6 deduction? Can I take chapter 6 deduction over here? Yes, even chapter 6 deduction 80C, 80D, 80G, etc. Whatever is chapter 6 deductions eligible for you, you can take that deduction. Payment link deductions are not stopped. What is stopped is profit link deduction assessee are not supposed to come over here. That's great, sir. Sir, how to determine the WDV of the asset? The WDV of the asset has to be determined in the normal way, the way you have been computing every year. You have to compute the WDV asset in the same way. Sir, will I get the deduction of remuneration and interest paid to the partners if I am a partnership firm? Because even partnership firm is eligible for 4480, sir. So if I make the payment of remuneration or salary or interest to the partners, will I get the deduction? Not allowed. Not allowed under 4480. Not allowed under 44ADA also, but allowed under 44AE. I am doing that interlinking for you all here itself. Sir, how many times I am supposed to pay advance tax? Generally, advance tax has to be paid 4 times in a year, but here the assessee government says that this assessee is eligible to pay advance tax only once in a financial year. This assessee once in a financial year by 15th of March. Next section 44ADA also once in a financial year by 15th of March, but 44AE the truck assessee has to pay 4 times in a financial year. And last but not least, once I follow this section, once I opt for this section, the government says that you have to follow this section for the next 5 financial year. Now in between, if you say that I don't want to follow, suppose in the 3rd year you say that I don't want to follow 4480, then you have to face serious consequence for that. So in the 3rd year, if you back out, then the government says that for the next 5 years, we will not allow you to come under 4480, and for the next 5 years, including the 3rd year, you have to maintain books of accounts, you have to conduct tax audit, and you have to prove to the government that what is your actual profit, and accordingly we will do the assessment of the assessee. So once you follow 4480, you have to religiously follow for 5 years. In between, if you back out, then for the next 5 years, you will not be allowed to come back to 4480. Okay. Now coming to 44ADA. 44ADA is available for whom? It is available to certain specified profession. Don't be mistaken that it is available to all professionals. No. It is only available to certain specified professions like legal, medical, engineering, architecture, accountancy, technical consultancy, interior decorator. Any other professions are notified. You can write down. Film artists are notified. Company secretaries are notified. These are some of the professions which are notified. They can also enjoy the benefit. When they can enjoy? When their turnover or gross receipt does not exceed 50 lakhs, their deemed income will be much higher as compared to 4480, which is 50% of the gross receipt. And this section is only available to individual and partnership firm, not even available to HUF. 44ADA is not available to HUF. Be very careful. This is only available to individual and partnership firm, and both of them have to be resident and resident. Otherwise, this deduction, this benefit of 50% of the gross receipt will not be available to you. Okay. Only individual and partnership firm, all of them have to be resident. Next, is there also a condition over here of 5 years? No. There is no condition of 5. Is the section available to LLP? LLP not available. Only individual and partnership firm. LLP also not covered. Is there a condition of 5 years over here? There is no condition of 5 years. You can switch out and switch in every year. This year you want to follow this, you can follow this. Next year, if you don't want to follow this, don't follow this. Follow the normal provision. Compute actual profits and show that profits to the government of India. So there is no need to do what? There is no need to follow that 5 years ka cycle like you have to follow in 4480. Here also you have to pay advance tax once in a financial year, that is by 15th of March, and rest of the provisions are same only like the previous section. Like you don't get any PGBP reduction, you don't have to do any PGBP disallowance, unabsorbed depreciation will not be allowed, but yes, chapter 6 deduction will be allowed, but yes, even the brought forward losses will be allowed as deduction, and remuneration and interest to the partners will not be allowed as deduction. Here it is allowed as deduction in the next section. Coming to the next section, 44AE. What does this section says that? This section first of all is applicable to all assessees. Whether you are resident, whether you are non-resident, whether you are individual, HUF, company, LLP, LLP, it doesn't matter. It is available to everyone. First thing, you have to keep this thing in your mind. Second, this section is available if you do not own more than 10 goods carriage at any time during the previous year. Even for a single moment in the entire financial year, you should not own more than 10 goods carriage. If you own more than 10 goods carriage for even a single moment, single day, single second, single hour, then you are not eligible for this section. Now, the government has divided all the vehicles over here into 2 categories, heavy and light. If the gross weight vehicle of the gross vehicle weight is greater than 12,000 kgs, then it is heavy vehicle, and if it is up to 12,000 kg, then it is light vehicle. For light vehicle, the provision is very simple. If it is up to 12,000 kg, the provision is very simple, very fixed deemed income, 7,500 per month or part of the month. For number of months the vehicle is owned by the assessee. So for every month during which you are the owner, you have to consider your income as 7,500. For one complete month also 7,500, and for half month also it is 7,500. But if it is more than 12,000 kg, here the problem starts. Here the deemed income is variable. Then the deemed income is for every ton there is 1,000 rupees. It means if your vehicle is 15,000 kg, it means it is 15 ton, then your deemed income will be 15,000 rupees. If your vehicle is 25,000 kg, it means it is 25 ton, then your deemed income will be 25. So depending upon the weight of the vehicle, you have to consider your deemed income. So for every month, 1,000 per ton per vehicle. For part of the month also it is 1,000 rupees. For number of months the vehicle is owned by the assessee. You can just check it over here. Now there are some point of differentiation between this section and the previous sections. That is, first is, in this section if you pay remuneration, if you are a partnership firm, and if you make the payment of remuneration or interest to partner, it is allowed as deduction under 40B. You can check over here. Plus in this section you have to pay advance tax 4 times in a financial year. And in this section also, if you claim that your actual profits are lower than 7,500 or 1,000 rupees per ton, then you have to maintain books of accounts, you have to conduct tax audit. You are free to do that. Okay. And one last section over here that will complete your PGBP income comprehensively. I hope you all have enjoyed the lecture to a great extent. One last section is section 44, which talks about insurance business. If you are engaged in the business of insurance, including mutual insurance company or cooperative society, your income will be computed as per the first schedule of the act. After the Income Tax Act is completed, after 298 sections of the Income Tax Act is completed, there are 14 schedules which are attached to the act, out of which the first schedule talks about the computation of income in case of insurance company. Fortunately, that is not a part of your syllabus. Okay. Now, one last thing I would like to do over here is I am interlinking the entire chapter for you all. Which are the sections where we have used the term manufacturing? We have not used. The government has used the word manufacturing or production. There are 3 sections: additional depreciation, scientific research, in-house research, and investment linked to deductions. And that is which 2 deductions? Investment linked three businesses. One is wafer fabrication manufacturing, one is production of fertilizer, and one is production of honey. 3 businesses. It was used production or manufacturing. Now, which are the section where the government has used the word company? Family planning. Then 35(2)(ab). Then investment linked deduction to business, that is cross country pipeline and infrastructure facility, only to companies, not to other assessees. And 35(c)(c)(d) only to companies, not to other assessees. Now, which are the sections where the government has used the word Indian company? Indian company is used in 35D preliminary expense. Indian company is used in amortization of exploration expenses. Indian company is used in amalgamation demerger expense. And Indian company is also used in 2 business of investment linked deduction, that is cross country pipeline and also in infrastructure facility. The deduction was only allowed to Indian company or consortium, that is joint venture of Indian company. Now, which are the provisions under the PGBP which are subject to amortization? It is not allowed in one single shot. There are around 6 expenditures which are allowed on amortized basis. First is capital expenditure of family planning, 1/5. 35D preliminary expense, 1/5. 35E amortization of exploration expenses, 1/5. 35DD amalgamation expenses, 1/5. 35DDA VRS expense, 1/5. And then telecom license and spectrum license. It is depending upon the life of the license and not dependent upon what? Over the there is no life given in the income tax law. It will be dependent on the life of the license. One thing I would like to correct myself. Here it is 1/10. In amortization of exploration expense it is 1/10. It is not 1/5. Now, which are the sections where the government is giving you deduction based on some percentages? 33AB 40% of PGBP. 33ABA 20% of PGBP before this deduction and before brought forward losses. 3617A in some cases it is 8.5% and 5% of GTI, and in case of scheduled bank etc. it is 10% of aggregate rural advances also. 3618, there are 3 points and whichever is lower, that is actual amount transferred to special reserve, 20% of PGBP and 200% of paid up capital and general reserve as on the last day minus special reserve account on the first day. 35D, first you compare with your actual expenses, 5% of cost of project, 5% of cost of capital employed, whichever is higher you will compare that with actual expenses, and then whichever is lower will be allowed as deduction. Sections where lock-in is mentioned, there are 3 sections where lock-in is mentioned. 33AB, 33ABA, 8 years lock-in period is there, and 35AD, there is an 8-year lock-in again, that you should not use your asset for a period of non-specified purpose for a period of 8 years from the beginning, from the financial year in which the asset was acquired. And last but not least, what are the sections in which there are new plant and machineries? There are 2 sections under the income tax law where the government has used the word new plant and machinery. One is additional depreciation under section 32 subsection 1 clause 2A, and one is 3580 where investment linked deductions are claimed. But in that investment linked deduction, there are two exceptions where you can have second-hand plant and machinery. First is up to 20% of total value, and second is if imported second-hand plant and machinery is purchased and if the no depreciation was claimed earlier, you can claim that imported second-hand plant and machinery as what? As your new plant and machinery itself. So this is the level of interlinking we have done in our entire book, and we have made it very concise so that on the day of examination you get a comprehensive look of the subject along with the conciseness. You cannot have a conciseness and comprehensive at the same time. That is what we have made it possible for you all. Okay, I hope you all have enjoyed the things. You go through it, and then we will go through some of the discussion of some of the important adjustments of the PGBP questions from your ICI material. Okay, because this revision, we are not only doing revision, we are doing revision with application. With application means with application of practical questions. Okay, just go through it once. So now come to question bank. We'll discuss some of the important adjustments of some questions over here. Now this is the second question. I have done starring category this time for all the questions in our question bank. As you all know, if you are my students, you would come to know that all the questions are divided into three categories: 3-star, 4-star, 5-star questions. Okay. So we'll try to adjust, do the adjustments for some of the important questions. We'll try to do maximum over here. If something is very simple, then we may not discuss over here. Okay. Now coming to the discussion over here, the first thing is, this is a very good question on depreciation, whereby they have asked us to compute depreciation under section 32. So now we have to compute depreciation under section 32. When they ask to compute depreciation under section 32, we have to compute the normal depreciation as well as additional depreciation. So on this new machinery, you will get normal depreciation 15%, additional depreciation 20%. On this windmill, you will get normal depreciation 40%, additional depreciation of how much? Of 20%. On this lorries, because it is a road transport vehicle, you will get normal depreciation, but you will not get additional depreciation on this lorry. On forklift trucks, you will get normal depreciation as well as you will get additional depreciation, but both of them will be half because it is used after 30th November 2022. On computers which are installed in office, you will get normal depreciation only, that is half, because that is installed in what? Office. Additional depreciation will not be allowed. Computers which are installed in factory, you will get normal depreciation half, and you will also get additional depreciation half because this computer is installed in factory. And last but not least, new imported machinery will not be subject to depreciation in the current year because it is put to use in what? In the next year. As you can see, in the next year you are putting to use, and therefore it will not be eligible for depreciation in the current year. Along with that, they are also giving one very important information to us, that you are buying all the assets by account pay check. That is very important. If you want to claim depreciation under income tax law, you have to buy the assets by account pay check, account pay draft, ECS or such other electronic mode. If you make the payment by other than these modes, you will not be allowed the deduction under the income tax law. Then coming to question number 3, the first question in this is, you are receiving some money in the form of non-compete fees that is chargeable under the head PGBP, as we all know, which is covered under 28(5)(a). If you make payment of what? Secret commission, that is not allowed as deduction. That is an illegal expense, therefore not allowed as a deduction. And the third one is, you are making payment to a foreign broker who is providing services out of India. He is not providing services in India. So if you are making payment to a foreign broker who is providing services outside India, so that income is not accrued in India. And if the income is not accrued in India, it is not taxable in India. And if it is not taxable in India, you are not liable to deduct what? The TDS on that particular amount. That to deduct TDS, the other person income has to be liable to be taxed in India. Otherwise, there is no sense in deducting TDS of those people who are not liable to pay taxes in India. Next, if you give a bank guarantee to the company towards bank, if a bank guarantee is given by a company towards disputed tax liability, whether giving of bank guarantee is allowed as deduction, the answer is no. I have also mentioned all these things in our easy notes, that is in our color book. Okay, if you make the payment, if you do not make the payment of interest to goods and service tax department, will you be allowed the deduction? The answer is no, because any payment made with respect to GST will be allowed on actual payment. On accrual basis, it will not be allowed as deduction. Then comes a very simple question, a very simple practical question is there, which is asking us to compute the PGBP income. So let's go through that also. The first adjustment over here is, you are receiving some gift from your client and you are crediting that to general reserve account, which is wrong. You should credit that to PNL, so you have to add back that much amount to your PNL account. Second, your creditors have foregone 2 lakh rupees because you were supposed to pay 10 lakh rupees to them. Now the creditor is saying that don't pay 10 lakh, only pay 8 lakh. That's fine. So that 2 lakh rupees is a remission and cessation of trading liability, which is chargeable as deemed income under section 41 subsection 1. Next, you have taken some loan from bank, and on that loan there is an outstanding interest. Now you are converting that outstanding interest into a new loan. So conversion of outstanding interest into a new loan is not amounting to actual payment, therefore no deduction will be allowed. Yes, out of that you have paid 2 installments in the current year. So if you have paid 2 installments in the current year, that will be allowed as deduction in the current year, as you can see over here. Next, you are making a payment of 5 lakh rupees to a foreign company on which the TDS was deducted and paid on 15th of July. So everything is well and fine. So you are making the payment before the due date of filing of return, therefore it shall be allowed as deduction to you. Okay. And last adjustment over here is, you are making a payment or to employees. You are making some payment to employees for what? Salary in cash. Why? Because your employee is going out of town for more than 15 days, and where he is going, he does not have a bank account, and you are deducting the TDS. Can you make the payment in cash? Yes, the payment in cash is allowed in such cases which I have said you, because that is mentioned as an exception in Rule 6DD, if you remember. And last but not least, you are making some payment to electoral trust. That is disallowed under PGBP, but it is allowed as a deduction under Chapter 6A under 80 GGB. Is it clear? Now this is a 5-star question, a beautiful question on 4033 AB, that is tea, coffee and rubber development. There is an assessee who is engaged in growing and manufacturing tea in India, therefore eligible for deduction under what? Under 33 AB. Now the profit of the assessee is 60 lakhs. So what are you supposed to do? You are supposed to first of all take 60 lakhs as his profit, and then out of the profit you will get deduction of how much? 40% of the PGBP income, that is 40% of 60 lakhs is 24 lakhs, or the amount deposited in the NABARD scheme, that is 11 lakh, whichever is lower. So the assessee will get 11 lakh as deduction. As I have told you, 49 lakh is his PGBP income. Now you do not reduce the losses. First you do 40-60. Once you do 40-60, then from the taxable portion you have to reduce what? The losses which are there in the question. So be very careful. First you have to do 40-60, and then from the taxable portion you have to reduce the losses. So how much deduction the assessee is getting? 11 lakh. Now in future, if the assessee withdraw that 11 lakh, so assessee has withdrawn 10 lakh out of 11 lakh, he has not withdrawn the entire amount, he has withdrawn 10 lakh, and he has purchased a non-depreciable asset. Is it allowed? Is it allowed? Obviously. Now he should not sell this asset for a period of 8 years. That's it. That is important. If he sells the asset within a period of 8 years, then it will be deemed income, and he also has to bear the capital gains implication. Second, he has purchased the machinery which is to be installed in office. Can you purchase the machinery which is to be installed in office? You are not. It is a prohibited asset in 33AB. You cannot purchase a machinery which is to be installed in office. That is a prohibited asset. Therefore, this 3 lakh will be deemed income. But will the tax be liable on 3 lakhs? No, no. The tax will be liable on 40% of 3 lakh. That is only the taxable portion of 3 lakh. Next. 1 lakh rupees you are investing, we are putting for the purpose of scheme, but after the financial year in which you are withdrawing in 23-24, but you are using for the purpose of scheme in 24-25. Therefore, it will be deemed income once again. You will not be considered to be a valid expenditure by the assessee, because once you withdraw the money from NABARD, you have to use it for specified purpose in the same financial year. Now, last but not least, you have bought this asset for 6 lakhs and then you sold that for 8 lakhs. So first of all, this 6 lakhs will become your deemed income because you are selling within 8 years. So how much will be deemed income? Only 40% of 6 lakhs will become deemed income. And last but not least, 2 lakh rupees will be considered as, that is 8 lakh sale consideration, 6 lakhs rupees cost of acquisition, 2 lakh rupees will be considered as what? As your capital gains, that is short-term capital gains. You can go through the entire question once more. Question number 6 is a very beautiful question on PGBP, computation of PGBP income. So let's see the adjustment. The first adjustment is a very beautiful adjustment where the department has done some survey and has found some irregularities. There was some irregularity in the closing stock, there was some irregularity in the opening stock, and there was some irregularity in the sale also. So you have to make a revised P&L over here, and you have to change the closing sales by 75,000. You have to increase, you have to change your closing stock, you have to change your opening stock, and accordingly you have to change your GP, and you have to compare your old GP and new GP, and whatever is the increase in the GP, you have to add that back to your P&L account, to the income statement. Okay, this is your first adjustment. The second adjustment is very simple. It's a IPCC level adjustment. Your income tax refund includes what? Interest. So interest will go to IFOS, and the refund portion is not subject to tax, as we all know. Bonus to staff 7,500 is included in this particular bonus to staff. Now because it is already included, it shall be allowed as deduction. You don't have to give any other effect because it is already a part of your P&L account, and you have made the payment of bonus in December 2022. So it is paid and it is a part of your P&L account, so no effect should be given for this bonus or to staff. Next one is you have made some repairs to your property which you have taken on rent, but the agreement says that you are not responsible to undertake the repair. So if you are not responsible to undertake the repair, still if you do the repair, then in that case you all know that that deduction is not allowed under section 30. I have given a specific note below section 30. You can go and check. That deduction is not allowed under section 30. That deduction is allowed under section 37(1). Next, advertisement in a brochure of political party, not allowed as a deduction under PGBP, but you can claim that deduction under chapter 6 under 80 GGB. Next, you are making some payment of 15,000 rupees for non-fulfillment of your commitment on time. So this is a compensatory penalty, not a penal penalty. Therefore, it is allowed as deduction. Next is a very simple adjustment. You are making payment to wife in excess of fair market value, therefore excess amount will be disallowed. Next is again a similar amount which we have seen in the previous question also. Next, if you make some payment for delayed payment of interest under GST, that is allowed, but if you pay any GST penalty, then that is not allowed. That is penal in nature, if you remember that. Next is you have made some investment of 25 lakhs for warehousing for agriculture produce. That will be allowed as deduction under 35AD. So this 25 lakhs will be deduction under 35AD, and this will be allowed as an income against what? Your warehousing charges. So your deduction is 25 lakhs, your income is 15 lakhs, and therefore the differential amount is your loss. Can that loss be set off against your normal income? That loss cannot be set off against your normal income. That has to be carried forward and set off against only 35 AD income for infinite number of years. Okay, that depreciation as per income tax law, you have to take deduction. Then you are making some payment of interest on loan on which you have not deducted TDS, so 30% of the interest will be disallowed. Only 30% will be disallowed, entire amount will not be disallowed. Okay, next one is a very important question on the Gujarat Guardian Limited case law, which I have explained you in the class also, which I have explained you in the revision videos also, and now also I am explaining you that you have taken a loan from an IDBI, which is a public financial institution, and you are making some lump sum prepayment to IDBI of 1 lakh or 2 lakh rupees. So the assessing officer is saying that the lump sum prepayment premium which you have done to IDBI, which will be allowed as deduction over the life of the loan, but the assessee is insisting that it is saying that this lump sum prepayment premium is nothing but interest only, because interest includes any other charge, service charge or service fee in relation to money borrowed. So the Delhi High Court in the case of Gujarat Guardian Limited held that interest includes this lump sum prepayment premium, because this lump sum prepayment premium is in respect of money borrowed, and therefore because it is borrowed from a public financial institution and it is paid actually to the public financial institution, it shall be allowed as deduction under 43B in one single shot, and it should not be apportioned over the life of the loan. Okay, next, if you take some machinery ka emergency part, will you get the deduction? Yes, because under income tax law you get depreciation on active use as well as on passive use. So this can be considered as a passive use if not as active use. This is a very simple question. I'm not interested. In fact, there is some mistake also in this question which is made by ICI, so I'm not changing that. So ICI has made a mistake, so I'm keeping that mistake as it is. I don't know why ICI is doing this particular thing again and again over the years again and again. So this question has some mistake in it. Okay, coming to the next question. Next question is again a PGBP question whereby you are having a complete PGBP computation of income question. First is you are making some excess payment to your related party in cash. So you have to apply first 40A2 and then after that you have to apply 40A3. Do you remember that if 40A2 and 40A3 both of them are applying at the same section at the same time, then you have to apply first 40A2, disallow the excess amount, and if the balance amount is more than 10,000 rupees, then you have to apply 40A3 also. Okay, next you are making some revenue expenditure because the expenditure which you are incurring is not increasing the benefit of the asset beyond its previously assessed standard. Therefore, it's a revenue expenditure. Therefore, it shall be allowed as deduction. Next, your creditor is foregoing some liability, therefore that is a deemed income under section 41(1). Next, you are selling some import license, then sale of import license is a PGBP income which is covered under section 28. You have to take that as a PGBP income. Next, you are doing some biotechnology business and you are also a company, so you are eligible for 35(2)AB scientific research deduction. For research equipment, you will get 100% deduction. Remuneration paid to artists, not artists, remuneration paid to scientists will also be eligible for 100% deduction. Since you have already debited 2 lakh to the P&L account, you don't have to do any effect because it is already a part of P&L account. Okay, now question number 10 is having two parts. First part is you have bought some buses, but the buses are not in your legal name, it is in the legal name of some other person, but you have the right to use that buses. So can you claim depreciation? Yes, the Supreme Court held that the owner for the purpose of income tax law does not mean the real owner or legal owner, it means the beneficial owner in the case of Mysore Minerals Limited. Therefore the assessee is eligible to claim deduction what? Under section 32. Second one, if the predecessor has sold the asset, and if the successor is claiming the bad debts of that particular asset, will the bad debts be allowed as deduction to the successor? Amalgamating company has sold the asset, but the deduction is claimed by the amalgamated company. Can it be claimed? Yes. The Supreme Court has again held in the case of what? Veerabhadra Rao K. Koteshwara Rao, that it shall be allowed as deduction in the hands of the successor. Don't worry about it. Okay. Now this one I am keeping pending because this is based on section 44A, and 44A we have not done so far. Whenever we'll be doing 44A, we'll be coming to this question, and it's a very simple question. 44A will come in the next chapter. We have not done that particular section as of now. Now question number 12, question number 13, question number 14, these are basic IPCC level questions which are based on what? Question number 15, these are all basic, question number till 15, all of them are basic IPCC questions which are based on computation of depreciation. Nobody is going to ask you such questions in the exam, definitely I am telling you 100%. Question number 16, it's a question on section 35, so we can discuss that. What is this question all about? If you make the payment to Indian Institute of Science, you will get 100% deduction of this. If you make the payment to IIT, you will get 100% deduction of this. If you make the payment to Indian company engaged in scientific research, you will get 100% deduction of this. If you do in-house research, development and facility, then you will get deduction under 35(2)AB, but you will not get the deduction of land in 35(2)AB if you remember. Do you remember that? But apart from that, all revenue expenditures you will get. Even building is not allowed as deduction under 35(2)AB, but you can claim that deduction under section 35(1)(4). Okay, so this is a very simple section on what? Section 35. Now this is a very good question which is based on what? 35 AD, that is your investment link deduction. So this is an assessee who is engaged into three business: warehousing of food grain, eligible for 35 AD; warehousing of sugar, also eligible for 35 AD; but warehousing of edible oil, not eligible for 35 AD, because 35 AD only covers what? The warehousing of agriculture products or sugar. It does not cover edible oil. Edible oil is not agriculture product. Therefore, whatever assets you will purchase with respect to these two will be eligible for 35 AD deduction, and whatever assets you will purchase with respect to edible oil, that will be subject to what? Depreciation. So you can see over here, you are purchasing some assets over here. You are purchasing some 80 lakh asset, then 60 lakh asset, then 50 lakh asset, okay, which is on land as well as building. So you have to first remove the cost of land out of it, because land is neither allowed as deduction under 35 AD, nor land is allowed as deduction what? Under section what? For under section 32 for depreciation. So first remove the cost of land, and after that, whatever is the cost, for food grain and sugar you have to claim 100%, and for edible oil you have to claim 10% depreciation. Further, you have purchased some building. So for this and this you will get full deduction, but for the third one you will get what? You will get only the depreciation under the income tax law, that is 10%. So you find out the deduction, then you see the profits, you reduce from the profits the deduction, you will get what? Your taxable profits. Okay, you can see this. So this is the catch in this question. So there is another question on 35 AD. Let's see this also. So this assessee is engaged in 3-star hotel, 35 AD. So this assessee has incurred 50 lakhs as capital expenditure. Yes, that will be allowed as deduction. Further 2 crore has incurred, but out of that 1.5 crore is on land. So 1.5 crore were not allowed. So this 50 lakhs is allowed, and out of this 2 crore only 50 lakhs will be allowed, because 1.5 crore is land. So total 1 crore deduction will be allowed. And what is the profit of the assessee? The profit of the assessee is only 25 lakhs. Therefore there will be a loss of 75 lakhs to the assessee. Can assessee set off this loss against another 4-star hotel? Yes. The 35 AD loss can be set off against any other 35 AD business. That's what the assessee has done over here. Is it clear? I hope it is clear. Okay. Next is also based on 35 AD. In 35 AD, there is a provision which says that once you purchase an asset and you claim deduction under 35 AD, then you cannot use that asset for any other purpose for a period of 8 years. If you do that, then whatever deduction was claimed earlier minus the depreciation which can be claimed on that asset, the differential amount will be deemed income. So that's what the assessee has done. Assessee has 2 units. Unit A is an storage of sugar, that is eligible for 35 AD. Unit B is for storage of edible oil, which is not eligible for 35 AD. Now the assessee has claimed some deduction and has said assessee after 1 year has transferred that asset for what? To unit B, that is for non-specified purpose. That is, so assessee has to bear the deemed income, that is the cost of the deduction minus the depreciation for 1 year. 45 lakhs will be deemed income under section 35 AD subsection 7B. Now, can assessee claim depreciation in unit B? Yes. In unit B, the assessee can claim depreciation on this 45 lakh rupees. There is no harm in that. Okay. I hope it is clear to all of you. The next question, question number 20, is based on what? Reduction under section 36 subsection 1 clause 4A, which says that employer contribution to pension fund is allowed as deduction, but only up to 10% of salary, if you remember. And salary here means basic salary plus DA in terms. So here the assessee is making more than 10% of salary. So whatever excess the assessee is making, that is disallowed under the income tax law. Only 10% of salary will be allowed as deduction. So the 10% of salary will come to how much? Will come to 2 lakh rupees. So whatever excess amount you are paying, that will be disallowed under the income tax law. That's what it is written over here. Is it clear? I hope it is clear to all of you. Now the next question is based on 3617A, which is provision for bad debts. So provision for bad debts. Can you get a deduction of actual bad debts? There's an actual bad debts of 210 rupees. You can get the deduction of actual bad debts if your actual bad debts are more than the provision for bad debts. So I have told you, when you compare the actual bad debts with the provision for bad debts, so you have to compare with the opening provision as well as current year's provision. Therefore, the opening provision is 100 rupees, as you can see over here, and the current year provision will be, because the assessee is a scheduled bank, the assessee will get 8.5% of 800 crore and 10% of the aggregate total advances. So 8.5% of 800 crore and 10% of aggregate total advances comes to 98. Therefore, opening is 100, current year is 98, total is 198, and the current year actual bad debts is greater than your total provision, and therefore 12 lakh rupees will be allowed as deduction under what? Under the section 3617 as your actual bad debts. I hope it is clear. Next is again a PGBP question, and this is again a company. Now this company is purchasing some raw material for in-house research, eligible for deduction under section 35. This company is also purchasing some in-house research development wrongly, and they are purchasing some land, not allowed as deduction under 35 2AB. They are purchasing some building. In 35 2AP building is not allowed as deduction, but you can claim the deduction of building under 3514. Next is you are doing some agriculture extension project. Yes, it is allowed. You are doing some notified skill project 35 CCD. Land not allowed, but other expenditure will be allowed as deduction. Land not allowed. You are making some expenditure in the advertisement in a brochure of a political party. Not allowed as a PGBP expense, but you can claim that deduction as what? As your chapter 6 deduction. PGBP it is not allowed. Next few sections are based on what? TDS, that you are supposed to deduct TDS, but you have not deducted the TDS. So in that case, if you make the payment to resident, then 30% will be disallowed. If you make the payment to non-resident, then how much will be disallowed? Then your entire 100% will be disallowed. That's what it is mentioned in the next few questions. This question is based on 40B. Whenever will be, this question is again based on TDS. Very simple section, nothing great as such. So I'm not interested in that. So let me move on to something important. This question is based on 40B. We have not done the revision of 40B so far. Whenever we'll be doing the revision of 40B, you can go through this question. Next question is a very good question. This question is based on you have taken a loan from public financial institution and there is an outstanding interest. Not allowed as deduction unless and until you make the payment. Now, if I convert that outstanding interest into a new loan, will I get the deduction? The answer is no, no, no. But when you pay that new loan, that time you will get the deduction. So conversion of this outstanding interest into a new loan will not be allowed as deduction. But when you make the payment, so they have made a payment of 5 installments out of this and 3 installments out of this. So whatever installments they have paid, so this is the total interest. They have converted into 60 installments. So per installment is 25,000, 50,000. So it is not allowed as deduction. But out of that 25,000, out of that 60 installment, they have paid 3 installments in the current year. So this will be allowed as deduction. 5 installments for first bank and 3 installments for second bank they have paid. So this will be allowed as deduction. So whatever they have paid, that will be allowed as deduction, and whatever they have not paid, that will not be allowed as deduction. Just conversion of an outstanding interest into a new loan. And after Finance Act 2022, conversion of an outstanding interest into a new security or debenture or bond, that is also not allowed as deduction. Next, Vinod is a film artist, and film artist is a specified professionals, and for specified professionals, they are liable to maintain books of account if their gross receipt is greater than 1.5 lakhs in all the 3 financial year preceding the current financial year. So in this case, the gross receipt is not exceeding in one of the financial year, therefore Vinod is not liable to maintain books of accounts. Is it clear? Next question is a very simple question which is on 44AD. The assessee is an individual doing retail trade business, having a turnover is up to 2 crore rupees, therefore assessee is eligible for what? 44AD business. Now, entire amount is received by account pay check, account pay draft, therefore the assessee is eligible for 6% of the deemed income, because if you do online transaction, only 6% will be deemed income. Third question, if Mr. Praveen does not opt for presumptive income, then what are his obligations? So if he does not opt for presumptive income, for the next 5 years, he will not be allowed to follow presumptive income, because in the last year also he has followed presumptive income. So if he has followed presumptive income in the last year, then for the next 5 years he has to follow. Now in the current year, if he says that I don't want to follow, then for the next 5 years he has to maintain books of account, he has to conduct tax audit, and accordingly the things will be dealt with. What is the due date for filing of return? If he follow presumptive income, the due date will be 31st July. If he does not follow presumptive income, then the due date will be 31st October. So as the case may be, depending upon what he does, the due date will change. Okay. Then comes the income under 44AE, where if you do not own more than 10 goods carriage, then you are liable for what? You are liable for 44AE. So now we have to check the weight. This is light motor vehicle, this is light, this is light, this is light, this is heavy, this is heavy. And for light motor vehicle, you have to take 7,500. So for the first 2 vehicle, you have to take 7,500 for 12 months. For the next vehicle, you have to take 7,500 for just 1 month, that is the month of March. For the next 3 vehicles, you have to take 7,500 for 9 months. For the next vehicle, you have to take 7,500 for Jan, Feb, March, that is 3 months. And for the last 2 vehicles, you have to take 1,000 rupees per month for per ton. So for both of them, you have to take 15,000 rupees. For first vehicle, you have to take from August to March, that is approximately around 7 months. And for the last thing, you have to take it for the month of Feb and March for 2 months. And this is how the things will change. This is how the income will be computed under the income tax law. Okay. Next. Next is based on 44DB, which we have not done so far. Whenever we'll be doing this section, we'll be coming to this particular question. Don't worry about it. Next question is based on what? Assessee is engaged in growing and manufacturing tea, coffee, rubber. So if an assessee is engaged in growing and manufacturing rubber, 35% taxable, 65% exempt. And if an assessee is engaged in growing and manufacturing coffee, 25% taxable, 75% exempt. And this is how you are supposed to compute the income under the head PGBP. Okay. Now next is based on some provisions of goodwill. As we all know that, what we know, that goodwill is not eligible for deduction for depreciation from 2020 onwards. So this question is about that only, and I have told you. So if you have purchased a goodwill in 2015, then on 1st April 2020, you have to remove that much goodwill from what? From the WDV of the block of intangible asset. So that's what it is done. first we have computed the total WDV of goodwill and other assets, and we have reached till 2020. Then we computed the WDV of only goodwill. Then out of the total WDV, we have reduced the WDV of goodwill, and the balancing figure is the WDV of other than goodwill. So that is what exercise we have done in this question. And last but not least, this question is based on what? This question is based on whether I am liable for tax audit or I am not liable for tax audit. So my 95%, my cash receipts are 4.58% of the total receipts, and my cash payments are 1.61% of the total payments, and therefore my total cash payment and cash receipt does not exceed 5% of my total receipt. Therefore, I am liable to do tax audit only if my turnover exceeds 10 crore rupees. Otherwise, I am not liable to do what? Tax audit. So this is what this question is all about. So this is what our first revision video is all about. I hope you all have enjoyed the lecture. I hope this revision video will help you to solve your problems of CA final direct tax, which is a mammoth, which is an elephant, which is an unimaginable universe. It's so big that it is never ending like universe. You have to accept this fact. So I am giving my little bit of efforts to make this subject as concise as possible from my side, but at the same time without compromising on the quality of the subject, without compromising on the minute detailing of the subject, without compromising on the interlinking of the subject, and now this time without compromising even on the practical application of the subject, because only revision is of no use without a practical application of that particular provision in the exam. So we are trying to do some exercise to even do what? The discussion of most of the practical questions which are there in our question bank along with the revision video. That will stretch the revision video to some extent, I agree, but that is very much relevant. That is what I found out. If you don't want to see the practical question part, you can ignore that. That's all your choice. That is absolutely your choice. But I personally feel that that is the most important part of this revision video. So if you have enjoyed it, take a pain of commenting below that what is your experience of learning income tax from me. And I don't know my English is good or not. I'm trying best to speak in English. I'm very good in Hindi. I know that, but as far as English is concerned, I'm not aware of that. I've not taught much in English. I've been teaching in English for the last 2 years only. But for Hindi, I've been teaching for the last 10 years from 2011 onwards. In fact, 12 years have gone by. So that's it from my side. If you like the video, you can like it, you can share it with your friends, maximum friends. You can share it with your all the friends in different groups across Telegram, across WhatsApp, across your classes groups, and share the good things so that good things come to you. To share good things, God will be blessing you and God will be returning good things to you. That's it from my side. Take care all of you. Bye. And the next revision video is coming soon. Take care all of you. Bye.